let's call it circa 1% up, a little shy of that. London maybe a little bit of a laggard, but we'll see exactly what it delivers on the upside. Maybe 2-3 is what we can expect early on. London's underperformed a little bit recently, after actually some quite positive noises around it. But the Stock 600 is now up by 0.4%, as is the IBEX this morning. We'll keep an eye on the banking sector over in Spain. But the Stock 600 up by, 0.4%. The CAC opens by 0.7%, so the Stock 600 starts to climb. The DAX is up by 0.9%. So a much more positive picture emerging in Germany this morning. But Europe maybe joining the party a little bit this morning, Val.
Look, it does seem like we are seeing those Nike results of late last night having an impact across European shares. JD Sports, the biggest mover to the upside, up nearly 5.5%. You join that with Puma's move 3.5% to the upside. Both of those two stocks have the biggest upside swing on the Stock 600s. When it comes to your sector, it's no surprise that retail is outperforming on the back of that as well.
Yeah, absolutely. So the consumer products and services does seem to be where the best performance is coming through, or where at least within that sector is doing well. Adidas, I think, also up by 2%. Even sticking to some of the luxury names, perhaps, they go a little bit higher. Maybe that's the broader narrative. It seems that the sectors that are sensitive to trade may be getting a boost today. Just, not necessarily any firm headlines to trade around, but we do have some of the car makers and the car parts manufacturers moving a little bit higher. That's the best performing sector in Europe right now, up by 1.5% on autos and parts. It would seem technology not having a bad day either. Utilities seems to be one of the few sectors in negative territory. 506
stocks up, 70 down. And the market is definitely on the front foot this morning.
Glass half full.
Glass half full seems to be the narrative. What I will say, though, is that the recent rally has not been delivered on great volume. So how convincing is it in terms of who is participating and how narrow it is? I read an interesting report yesterday talking about the technicals around what we're seeing in the States, just how narrow the market is. And it needs to broaden out if some of the technical sort of factors are going to be continued on the positive front foot nature that we've seen of late. So yeah, I think this is a market that what feels like it wants to go higher. But to Mark Cumberland's point, given the news flow, should it be even higher? And you just kind of wonder whether or not actually the market is
so
as
you're
glass.
Bullish guy? Are you bullish here?
No, no, let's not go too far.
We've discussed on this program before how that doesn't fit the accent.
We
apparently,
should be higher. That's what he just said.
Yeah,
some of our audience.
It should be even higher than it is. So therefore, by extension, that is bearish.
Let's talk to Sophie Ewan, portfolio manager and strategist at BNP Paribas Asset Management. Sophie, very good morning. Thank you for joining us. So do you think that, there's a lot of complacency in these markets? There are lots of things to worry about, and yet stocks go higher? Or, to the point that we're sort of making there, do you think that given all of the at-the-margin positive news flow, maybe stocks should be even higher than they are?
I think there's a very short-term focus on the latest narrative, some kind of trade deal or potentially trade extension beyond the 9th of July. But also how the economic developments supposedly are not that bad. But at the moment, I think there's a disconnect between markets, which want to price the bullish narrative, and the macro data, which are pointing towards risk to the downside. And I think it's quite interesting.
Yeah, I mean, that macro data to the downside, though, being taken as a positive, though, isn't it? Because it reinforces the need for rate cuts. Thinking about the trade narrative there, and we've got ourselves excited about that, it would seem, this morning. What do you think markets are really expecting from July 9th? Are we just expecting some, I don't know, maybe 10, maybe fewer, framework deals that don't have very much detail in them, and then a whole lot of talking from there? And crucially, what will tariff rates look like in the meantime? Are we assuming they stay where they are for a very long time?
I think if you look at what you were talking about, the open on European stocks, it could be a follow-up of what happened in the US. But I think it's also pricing out potentially a tariff above 10%, which might be right or wrong. But what we could have beyond the 9th of July could be an extension of the tariff, where they are, more negotiation, because I think for now it's been China and 10 other countries, but what about the others? So I think there hasn't been enough time to negotiate. We could have an extension, which is going to feed into a bullish narrative for equities. But the question is, when are we going to have the reality check?
Yeah, Sophie, I guess the thing that I'm having a hard time dealing with is an extension already priced into the market? It's such a hard thing to understand, but it does seem like to be, at least from the market's point of view, they're not that jittery about this deadline extension. Do you think that there is an assumption that we're just going to get another 90-day extension?
I think what's not priced at this point is potentially pricing out the stagflation fears. So if you look for now, the gap between where tariffs were and where they are now, it's been a massive increase. And yet the impact on inflation print have been quite muted. So I don't know if you follow this $1 billion project, Alberto Cavallo. So he's basically monitoring price indices on a daily basis, monitoring for retailers. And for now, the price increase has been really muted. So does it mean that front loading so far have been feeding into inflation and that's why it's quite muted? Or really tariff are going to be taken, like the hit is going to be taken by corporates? And in the end, there's not going to be massive economic impact.
That just echoes what Chair Powell has been saying a lot, that we just don't know where in the supply chain the pain is going to fall. Does it fall on the consumer? Does it fall on the margins? Or is it a whole mix of all of the above?
Yeah, you could argue, though, if it doesn't end up hitting the consumer, it just means more is left on the company's margins to the downside if the companies are eating it. So maybe you can argue that it's perhaps negative for equities if these price increases don't make it to the consumer. Just painting out some nice pictures for our audience here, Guy.
Just checking, just to make sure that things are as they should be. What does the dollar do to the outlook? Say we get to 120, say we get to 125. How does that change the narrative, particularly for European investors?
So if you look at euro dollar, I think everyone is bullish now. It wasn't the case 6 months ago where dollar bears were feeling very lonely. I think at this point what could play in favor of euro is like further FX hedging flows. When European investors could say, do I really want exposure to US dollar at this point? Might not, so I'm going to start hedging more. Yeah. And if the Fed is actually going to cut, then the cost of currency hedging is going to go down. And then the second thing is, if you look at the year-to-date inflows into European equities, it's only 1/3 of the outflows we got in Ukraine, so potentially much more upside going forward at a time where you have new thematics developing in Europe, right?
Okay. A lot of investors are still long the United States. Yes. That unwind continues. Does the euro accelerate that? Why should I be... If I believe long-term the US markets are going to do well, do I invest but on a hedge basis? How do I factor into my investment decisions what I do with the currency? At the moment, this week, for instance, the S&P's up 2.5%, but if I'm a euro investor, it's up 1.2%. How big a headwind is the euro going to be to any investments that I think about in the United States?
I think you're going to have European investors that are going to start to decrease the exposure to US dollar. Like if you think from a valuation perspective, dollar is a sell from here. So I think we're going to continue seeing European investors decreasing the overweight into US assets, both on equities and bonds. And in US equities, it's going to be much more thematic driven. So AI, for example, it's not going to be as broad-based as before. And then diversify and put more into European equities with defense or the banking sector.
Sophie, what's your thinking on the defense sector in Europe right now? Because it attracted a lot of attention, but a lot of people sitting in this chair have suggested that some of the names are looking expensive. But if we get dips, do they just get bought because of the overall thematic narrative? Or does the market stop believing that it can all be delivered at some point? What are you thinking?
So our equity PMs internally are still very positive on the defense thematic. They think it's a multi-year investment opportunity that we're going to get. I hear the worries about like how multiple expansions have gone. In terms of earnings expectation, I think it's twice the market at this point for the next 3 years. So there's worries about that, but I think it's one of the themes you can basically highlight in Europe. I think people will continue to buy on dips because it's something that is going to continue on a multi-year basis.
All right, so we haven't hit peak defense yet for Europe. What's your view on U.S. tech stocks, though? You did mention that if European investors were to dip their toes into U.S. assets, they'd do it more on a specific basis. Do you think there's still a lot of tailwinds for AI stocks?
So I think it's quite interesting, your question and what you said earlier about like more optimism. So if you look at earnings momentum in the US, you look at upgrades versus downgrades, it's been picking up across the board. But in the US, it's across sectors, but more particularly in the IT sector. So with this renewed interest in AI, but also an upgrade of earnings expectation. So on that, I think AI, US stocks are going to benefit. But if you look at Asian stocks and the performance of Summit stocks, also Korean stocks, there's been this broadening out of AI boom. And I think it's going to be much more beneficial across the board than this concentration in the US.
Sophie, great to see you. Thanks for stopping by to see us. We always appreciate it. Sophie Yun, Portfolio Manager and Strategies at BNP Paribas Asset Management. Core 6 looks like this. Let's take a quick look at what some of the leading stocks in Europe are doing this morning. And as you can see, there is an awful lot of green on the screen. Schneider is up over 3.5%. Even Nestle, which is a defensive stock, is up by 0.5%. Luxury is doing relatively well. Tech is doing relatively well. Novo's up by 1.3%. As I say, there's a lot of green. What else is there that we should be watching? Joe Easton has the details.
A lot of green in the sportswear sector today, Guy. In particular, we've got Adidas gaining, Puma as well. Puma up almost 5%. JD Sports gaining nearly 7%. One of the best performers in Europe today, all coming from Nike. I'm going to go with Nike because I am British rather than Nike, but that one is boosting the entire sector. So JD, one of the biggest partners of Nike in the US and in the UK as well. So getting that boost there in terms of the better than expected sales update, or at least the guidance from Nike last night. So we're seeing significant gains in those. Adidas needs a boost as well, that one. And Puma, that was down 50% on a one-year basis heading into this report. So getting a good little read across from the Nike results coming through last night. Then in terms of the gold miners, looking a little bit softer as expected, given the drop down that we saw in the precious metals prices overnight. But again, these stocks have done really well. They've rallied over the past year or so, given the big move higher we've seen in gold. So gold only a few $100 away from its record high still. So still, they're getting a big boost. But for today, we are seeing little losses with gold set for its second weekly loss. So it was down last week, it's down this week, and that's feeding through into those stocks today. Then utilities, we had these on the radar, firstly because of this news around Centrica potentially going to buy a stake in this big new nuclear project in the UK. That's worth more than £1 billion in terms of what they might spend on that. But then we had Bank of America as well, the strategist coming out and downgrading the sector today, so turning negative. This is a valuation call, though. It's all about the big rally, and they think that's probably gone a bit too far now. It's rallied given the defensive stance that people have taken in the markets over the past few months. So they come down in terms of those stocks. Over in Spain, we've got Indra Sistemas. Now, this is described as a hidden defence gem by analysts at Morgan Stanley. It was a software company, but it's pivoted towards defence, kind of getting on trend, on vogue in terms of what they're doing with their business. So they've shifted to defence, and as we know, all the defence stocks have rallied. Morgan Stanley says you should be buying that one as a way to buy into the defence rally. And then finally, in the UK, we've got Pearson. This is the education company, does all the exams and other university education. It's getting a boost because it has got an upgrade at BNP Paribas. They say that a recent sell-off linked to a profit warning from an Australian peer has actually sent the stock too low. So they think you should be buying the dip in Pearson, and Pearson stock rising 2.3% in London this morning.
Thank you very much, Joe. Joe Easton from our equities team. Coming up, see, I'm listening to Joe. We'll talk about a big US sportswear maker. It's soaring in after-hours trade as its turnaround plan finally seems to be paying off. How is this playing out? Well, it's playing out positively for European sportswear manufacturers as well, the likes of Adidas and Puma. We will get back to that story in a moment. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Welcome back to the opening trade. 17 minutes into our European session, and it's green. It's greener than perhaps we anticipated on some of these markets, up by nearly 1% on the CAC 40. It seems that trade narratives and the Fed narrative helping to lift market sentiment a little bit towards new highs for global stocks. Let's talk about one stock that was doing really well after hours. That's Nike. Shares of the sportswear manufacturer going higher thanks to a brighter outlook, hinting that the CEO Elliott Hill's turnaround plan is starting to work. Sales are still expected to dip this quarter, but less than had been anticipated. Really interesting commentary on the supply chain as well for a consumer company. Let's talk to our Bloomberg consumer reporter, Sonia Vinti, who has been covering this and looking at the read across into the rest of other European names. Sonia, nice to have you with us. Is this the start of a turnaround then for this business?
Well, it could be. I mean, it's clear the quarter was quite painful. It was one of the worst performances, quarterly performances Nike had in recent years. But it was better than the market has feared, as we can also see in the stock price reaction. And the CEO also said that the worst could be behind Nike now, and things could start improving from now on as his turnaround strategy is starting to take effect. So he's basically trying to undo the missteps of the predecessor. So that includes improving the partnership with wholesale partners, to backtrack that misstep in direct-to-consumer sales, which made it lose market share to rivals On and Hoka. It's also doing partnerships like with Kim Kardashian that could help bring shoppers back to the brand. And it's clearing out excess inventory to make space for new innovations, new designs. So it could be the start of a turnaround, but of course we have to see whether those changes will really take a hold in the coming quarters now.
Sonia, I think many were looking at these Nike results as perhaps a macro indicator of how a big multinational corporation is dealing with tariffs, given Nike has so much exposure to Vietnam. Did we get much color on how they're dealing with the tariff impact?
Well, it's clear that the tariffs are a big challenge, and Nike said that the cost headwinds from the tariffs could be $1 billion in fiscal 2026. So it's definitely a challenge. Nike is trying to address that with the strategy of reallocating its production from China to other countries. So currently it has around 16% of its US footwear produced in China, and it plans to bring that down to a high single-digit percentage over the coming quarters. So that could help mitigate some of the headwinds. It's also looking at corporate cost cuts and also how much it can pass on price hikes in certain items for consumers. So that could kind of help to cushion the impact, but the main priority is also to reignite the brand heat of Nike. The CEO is trying to do that with a renewed focus on core sports areas, especially running. And the hope is that the new products are going to excite consumers again. We saw some early good signs on that. So the new running shoes, they had a warm reception, and also new upcoming launches like the Air Max Phenomena has seen some online buzz going on. So if that energy translates into sales as well, then that could help it to power through the headwinds that we're seeing from tariffs.
Great stuff, Sonia. Thank you very much indeed. Sonia Vind on what is happening with Nike. I'm going to go with Nike, though I guess if you're going to go with the Greek goddess of victory, it should probably be Nike.
Do you guys have this fight every earnings season? Oh,
it feels like it, yeah.
I
am concerned that Anna has decided to go to the dark side.
I think the UK moved on, Guy.
I don't care. I haven't. Michael Masika's sitting next to me. He's going to save me. Bloomberg senior strategist. We're going to talk about banks, though. Much more sensible subjects. European banks have had a great run. You're concerned that maybe that's beginning to become a little bit more nuanced?
Yes. So we've seen over the past 5 years the stellar returns that they had. I mean, we're talking some of those banks had like are up 1,000% in total return. Talking about Sabadell, BPM, all those banks that are involved in M&A especially. But even like UniCredit, which is like the consolidator of the sector, is up like 800% for the past 5 years in total return again. So those stocks, they've been returning a ton of cash to shareholders through buybacks, through dividends, because they had the opportunity to do so, because their earnings have been growing at a very, very fast pace. And now we're seeing, obviously, this is slowing down slightly. The ECB has, cut pretty much everything it can cut in terms of interest rates. So we're going to start to see those feeding into earnings with like less growth. And obviously, we can't expect banks to be the driver of the European market like they have been over the past 5 years.
Is that going to be what's the theme that we're trading around in Europe, do you think, then, Michael? You've written a piece this morning that says we're looking for a fresh catalyst. I mean, the market seems to have got itself excited about the possibility of trade deals this morning because we've heard some news lines around China and the US and a little bit of a holding statement on Europe. If we are returning to thinking post the Iran-Israel conflict, if we're returning to think about trade, does that sound like markets up to you?
Well, let's say the tariff issue has been a little bit forgotten over the past few weeks. We're having a deadline next month, and we still don't know what it's going to be, especially for Europe. So yeah, maybe we have like a very positive catalyst in the sense that if there's a deal with China, this is also positive for Europe. But at the same time, I mean, we've seen how long it takes in Europe to get a deal done. I mean, we live in a country which had like a lot of trouble finding its deal with Europe. So we're still waiting to see what's going to happen with the US on that front. It's a big uncertainty.
Maybe it's going to be the U.S.-European deal that's going to take ages instead of the U.S.-China one, which I think many of us thought was the deal that was going to take years. I guess the question really is for European stocks. We have all this good news priced in. What is really going to be the next kicker? Because I mean, it's never been so good for European stocks at the moment. And really, they've only outperformed the U.S. by 3%, Guy? Maybe.
Do you want to currency adjust that? Do you want to
maybe you can. But I don't know. I just, you would have thought that with all of these tailwinds around for Europe, that they would be, outperforming a bit more.
Yes, they had outperformed a bit more up until recently, where we had like a big catch up from the Nasdaq and all the big tech. At the moment, what we're seeing is the demand for European assets is still strong. It doesn't mean that Europe is going to outperform the US for a long period of time, but at least investors expect them to bring the same type of returns as the US over the next year or so, maybe longer than that. And that's where the catalyst is in terms of like where Europe is going. If there's like an appetite for European assets and some assets that are being brought back to Europe, all those assets that have been invested in the US for so many years, you will have like some push on the European markets.
Do you think that maybe an international investor is looking at how long this BBVA Sabadell deal has taken to get approved, and then approved with all of these, red lines that might eventually stop the merger, seeing that as a big headwind for the fact that Europe really does need banking consolidation. It needs more liquid capital markets, and it seems like it is just not being an easy time.
Yeah, we've had consolidation in the banking sector. It's not enough, for sure, and we need more. But, the red tape in Europe is the red tape in Europe, and it's always getting to the point where you get those hurdles. Is that deal going to happen? Maybe, maybe not. It's a problem for an investor, for sure, and that's where Europe is always having trouble to, keep the momentum going, because there's always a moment when they kind of mess things up, and I hope that's not that type of moment, but we'll see.
That's the technical term. Michael, thank you very much for joining us. Bloomberg Senior Strategist Michael Masika with thoughts on the markets and where we find another catalyst, or where these markets head from here. Let's have a quick look at some of the lines coming out of China. We had news overnight from the US side that there was further agreement around the previously agreed Geneva agenda on trade between China and the United States. Well, we've just been hearing from the Foreign Ministry in China, and they've also been talking about things to do with Europe, so the China-European story moving a little. Wang Yi is planning to visit Europe June 30th to July 6th. I mean, what stands out to me is just the timing of that, coming right before July 9th. It's pretty soon, and it's coming just before we get, supposedly, some deals with the US on trade.
To your point about Europe, if Europe doesn't get a deal, does this sort of outflow out of the United States into European equity markets, which we've seen a little bit of, does that just stop? How cataclysmic would that be for this narrative?
Yeah, what is the baseline assumption? Are you just assuming that the current tariffs stay, if that's the case, as conversations continue? We'll continue to get soundings from the market. We'll be back with more shortly. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. It is Friday morning, 30 minutes into a session that is turning increasingly positive. We're up by 1.3% on the CAC 40. So we do seem to have found optimism in the trade conversation and in the Fed narrative, perhaps, that has led to higher stocks this morning. And US futures, Valerie, pointing a little bit higher. Take us through some of the data story coming through from the US.
Yeah, we got a lot of US data yesterday. It did tell a few different narratives, so I thought it would be pertinent to go through them. The big one was on jobless claims. We've seen a consistent rise in continuing claims. It actually hit a cycle high yesterday. Now, this is happening while we have initial jobless claims coming in lower than expected. So it's really begging the question of whether there's labor hoarding going on in the U.S. economy, that maybe U.S. companies are treating their labor differently after the lessons of COVID. We also got GDP revisions for the fourth quarter. It was the final print of GDP for the first quarter. We did see a revision down, a lot of that having to do with a lower reading on personal consumption. I think this is pertinent, Anna, because we saw this revision down, especially when it came to services spending. And I think that could be a theme that we could see in the PCE data today. Bloomberg Economics expects a weak reading due to the fact we are assuming that services inflation will be a big drag down and it'll offset any tariff-induced goods inflation on the other side.
Let's talk about this in a little bit more detail. The perfect person sitting next to us, Steve Blitz, is here. TS Lombard's chief U.S. economist. Val, running through the data in terms of what we're seeing. There is some ambiguity in the data coming out of the United States at the moment. What is your overall impression? An economy that's slowing, but not that fast? An economy that's slowing fast enough to deliver rate cuts? What is the overall picture?
I think the economy is slowing enough to give us a little bit of a rate cut. I think we'll have... What does that mean? Well, it means 25, 50 basis points. It doesn't mean 100 basis points. We're not like we were in September, where
but just one or a series of back-to-back cuts?
Well, you know, the answer that everybody hates, it depends. But I think
you're an economist.
Yes, but I think it's definitely a number that. Look, I think that the economy's slowing down. The problem with the data, with income, especially spending data, is that you have a tremendous amount of distortions, right? Because you had a lot of early buying by business as well as households. You had to jump in auto sales to get ahead of the tariffs. Now you're seeing a slowdown. So to say that's a slowdown is really just you had a lot of pre-buying. So you're not, you know, real imports were up 50% in the first quarter. Yep. You're not going to be up another 50%. In fact, you're going to get a big pullback on that, right? So when you add all that up, the employment numbers really become critical, and then the employment numbers are somewhat distorted because you're losing labor because of deportations and this type of thing. So it's very difficult, but when you look at claims and you see them pulling up, when you look at coincident indicators like TSA... Travel data. That's negative year over year, even though the economy's higher. So these are signs that are telling you that the economy is fracturing, you know, on the margins. And now that inflation seems to be in the closer to 2 than 3, there is a little room to cut. But, you know, the Fed Powell is concerned about the coming hikes, right? From the inflation hikes. The inflation hikes. And he doesn't want to get caught like he did the last time.
How are you viewing when exactly this tariff-induced inflation hits the economy? And could perhaps we're maybe underestimating the amount of deflation that could come from services inputs? Because services makes up 2/3 of CPI. You know, goods is only 1/3. Could it be completely outweighed?
Well, I think the service side, though, is fairly constant, right? So so the real volatility in CPI, one of the reasons you take food and energy out, comes from the good side, right? And the other thing is the good news on U.S. inflation for the past 30 years was that CPI goods, ex-food and energy, was zero from 1990 to 2019. So it is a critical in that sort of 2% side to get back to that importation of deflation or disinflation, however you want to think of it. Now, going forward, the thing about the price hikes that I think people aren't particularly focused on is that this is a tax on tariffs or a tax on earnings, right? Because this is how the U.S. trade deficit is created, right? And so firms have a number of ways to figure this out. The weaker employment is currently, the less likely we're going to see hikes going forward, right? Because they're not going to be able to pass through these prices. And firms have the option of readjusting payroll to keep their margins where they are. And no one seems to really want to internalize that part of it. It's like, well, it's either margins or prices or some mix, but there's also a payroll adjustment that's out there.
No, that's interesting. So you're saying that if the labor market weakens, we're almost less likely to then see tariff-induced inflation off the back of that.
Right. So, which is why I think that the June payroll number is pretty important, right? Because if June payrolls look like the last few months and continues to show a slowdown, you really have to lose confidence over how much of a tariff price hikes you're going to see in August, September, October, which is when everyone thinks the CPI numbers are going to jump higher.
Do you have a number on NFP next Thursday that could tempt this July cut that we've seen growing in speculation?
I think anything under 50,000, 65,000 would do that. Yep. Because 75 to 125 is considered neutral in terms of payroll growth against population growth, right? So anytime if you're above that, they get a little concerned. If you got a 200,000 number, you're not getting a cut in July, but you know what? You're not getting a cut in September either, because that means that the economy's strong enough that all these price hikes are going to come through, and all the things Powell's concerned about.
The survey number's 120, the whisper number's 111. So we're not at those kind of very low levels yet.
No, but those are the kind of low levels that you think would prompt those cuts. Can I dwell on the inflation subject for a little bit, Steve? Because
wherever you want.
Thank you very much, because I'm really interested in this, the propensity of businesses to put up prices, or the confidence with which they would do that or not. Because we've just come through a period where businesses had to relearn what inflation is all about and re-understand the level of pricing power they had. And they had a lot of it. And they did okay with that. And they pushed up prices, and we know what happened elsewhere in the economy. And that lesson is still very recent. And I wonder if that has an impact on businesses when they're looking at this and the inflation that, the way the tariffs could weigh on their businesses, and maybe they're more likely to try and pass them on.
Well, they're going to try, but that's what I think is very interesting, right? Because you've got this front loading of inventory, right? And what people are learning, guys like myself who go way back to the high inflation, we understand that firms price not against inventory costs, but they price against the cost, the projected replacement cost of inventory, right? Now, when you have low inflation, that's kind of a meaningless difference. But when you have inflation, like we saw in COVID, it becomes meaningful. So now you've got a lot of firms with a lot of inventory pre-tariff, but they know they're going to replace that at a tariffed price.
Yeah.
So now they're trying to figure that out. So I think firms are in the process right now of figuring out just how much they have to eat, how much in terms of margin, their suppliers, their exporters, the whole chain.
Yes.
Or how much they can just pass forward or not. And we're in this discovery, and that's why in this coming quarter, this is where all this stuff is going to start to show up. And so that's why I think it's a higher volatility quarter that's coming than what the market is priced.
Back to the weakness of the data, I suppose. We know the market has been rethinking Fed cuts and coming around to the idea that we get more of those. That's what we've been talking about this week, partly due to weakening data maybe, but also partly due to the Fed chair conversation and the fact that President Trump keeps pushing back against Powell. How important to the market do you think it should be, this conversation about when a new chair is announced?
The media loves it and the market loves it, but I don't really think it really matters all that much, honestly. I think when the next Fed chair is announced, and we're going to know this in the fall, right? Because he or she has to be approved by Congress. His term doesn't end until May. And so it's not like this conversation is going to get a little bit closer. And I think if anything, given that Trump's going to want somebody who's going to bend to his will, which really means that it's going to be a Fed chair that's going to bend to the needs of Treasury, right, in terms of financing government, that the longer end of the curve is going to do worse than the shorter end of the curve. You know, he's mistaken, Trump is mistaken to believe that if you just cut the short end, all rates are going to come off. That's true if the Fed's cutting the short end because there's a recession or a real slowdown in growth. But if they're cutting it and the economy is still running at 150, 125,000 in payroll every month, the long end of this market is going to do worse. And especially so, remember that 4.5% of GDP is what the U.S. imports in capital every year. So the non-dollar investor is critical. Yeah. And that same gross surplus of funds around the world to come in, because everyone else is doing things, it starts to go away.
Harder to control the long end. We've talked about that a number of times.
Yeah, and maybe this dovish Fed chair pick could really blow up in Trump's face if we do get this long end bear steepening that could make financing costs for the U.S. even worse.
Steve, thank you very much. Thank you for joining us. Steve Blitz, TS Lombard, Chief U.S. Economist. Always a pleasure to have you in the studio. Thanks for joining us. Next week, Bloomberg is live at the ECB Forum on Central Banking in Sintra. So a little bit more of a European flavour, perhaps, but still thinking about these global inflation and growth themes. Join us in Sintra, Portugal, on Tuesday as Bloomberg hosts a policy panel with the world's top central bankers. That's at 2:30 p.m. London time on the 1st of July. Coming up on the programme, just how historic was this week's NATO summit? Bloomberg opinion columnist and author Max Hastings joins us next. This is Bloomberg.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Our global headquarters in New York, I'm Danny Brown.
Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
44 minutes into the equity market session, European equities are on the front foot. I tell you what's not on the front foot, though, is the defence sector. It is weakening up. Hensoldt down by nearly 5% this morning. Rheinmetall is down by nearly 4%. Babcock's down. Leonardo is softer as well. So the defence trade is definitely coming off. This after a week when we've really focused on what the defence sector is going to do next and the spending numbers that are being delivered out of Europe. NATO leaders this week agreeing to increase defence spending to 5% of GDP, with President Trump branding it the most unified and productive summit in history. But in private, EU leaders have reportedly made coded criticism of Spain's refusal to accept that 5% goal. Joining us now is Bloomberg opinion columnist Max Hastings, author, of course, of mysteries including Vietnam, an epic tragedy and Abyss, the Cuban Missile Crisis. There are others, and they are definitely worth reading. Max, very nice for you to join us this morning. Was it a productive summit?
It was a very productive summit in that they prevented Donald Trump from throwing all the NATO toys out of the pram. Nobody at the summit was being honest. That everybody gave this terrific cheer for Donald Trump, spooned on the flattery in a fashion that nobody's seen, I don't think, in the history of any NATO summit going back to the 1940s. But it had to be done because this appears to be the only way to deal with this American president. The summit had two objectives. One was to prevent Trump from breaking up NATO, and the second was to prevent him from pulling the plug on Ukraine. And for the moment, both those objectives appear to have been fulfilled. But the price was a loss of self-respect, because almost every European leader present said things he didn't for a moment believe. He said that he supported the American strikes on Iran, which most European leaders do not. And I'm afraid I'm an old skeptic about the numbers that have been produced about getting to 5% of GDP spending on defense by 2035. They're all going to be retired by then, which suits them down to the ground. I don't believe that's going to happen. But if it keeps Donald Trump on side even for a week, it's worth it.
Okay, yes, a lot written, and you have around the use of flattery at that summit. Really interesting piece there. But thinking about the 5% commitment, Max, and the reality of it, I mean, I know that we will continue to have conversations about where is this money going to come from. But if this were to become more existential for more European countries, isn't there a sense that maybe the bond markets in that situation might be more forgiving?
Some countries, including Spain, have made plain that they have no intention of making any serious increase in military spending. Other countries, the Germans have made enormous pledges. The British are doing our best. But all the national exchequers, Europe is having a very rough time economically. And I personally have serious doubts whether any of these terrific projections for spending are going to be met. It's very difficult for European politicians to get European voters to sign up to defense spending. Now, those of us who are sort of in the business and who take strategy and defense very seriously are appalled that for many years, the one thing Donald Trump's been dead right about is that Europe has had a free ride on defense. And that time is over, because we're now dealing with a newly assertive and aggressive Russia. But it's still very hard politically to get European voters to take this seriously.
Max, do you not think that that's a big risk for these European nations, given they've promised 5%? Maybe if they don't get there, you know, in 3 years' time, that's only going to irk the U.S. president even more?
Well, by then, everybody's rather hoping that this American president will have gone. They're playing for time. It's a game. I don't think it's a very honorable game, but maybe it's the only game in town. Maybe it's what they've got to do. But governments have got to say one thing. Governments have got to make the supportive noises to Trump They've got to flatter Trump. People like me and you do not have to do that. So I think we should try and tell the truth, even if our politicians are not.
Max, is it guns or butter? And if it is guns or butter, how you're making the point that at some point the reality is going to come through, and we need to be making that clear. You've got a story on the front pages of the UK newspapers this morning talking about the fact that Keir Starmer is having to climb down on welfare spending. That's the butter. But he's also in the same week delivered an outlook for defence spending that is sharply higher. In terms of how it plays out on the butter side, is there a danger that ultimately we do see political ructions in Europe because politicians have to make cuts and the tension is going to rise? I'm just wondering how you think this plays out on either side of the fence, and whether or not actually we are heading to more political chaos in Europe as a result of some of the commitments that are being made.
I think you're absolutely right that very difficult dilemmas are ahead, because it's very hard to take an optimistic view about public finances, not merely in Britain, but in Europe generally. Public finances are going to be under enormous pressure, not just this year, but for years to come. The German economy, we know, has got very serious structural problems. And in the midst of all this, to tell voters that they've got to give up on important, huge sums of money, many billions of money that at the moment goes on welfare and health and so on, for defence, is very tough. So I think that there are going to be some very difficult choices. And the hardest part is to get anybody involved to tell the truth to voters about how serious the risk from Russia is, and to tell voters that they're going to have to give up on some other stuff in order to defend ourselves seriously, because most of the armed forces of Europe at the moment are in no fit state to fight anybody. And that, of course, is one of the things that's so embarrassing about Ukraine. But if Donald Trump pulls the plug on arms supplies to Ukraine, we, the Europeans, simply do not have the means to replace those lost weapons. We are almost naked.
Yes, and Max, I know that Europeans probably, the legacy or the history tells us recently at least, they would prefer to fight Russia with sanctions. We've seen sanction package after sanction package. Any sense that any of this is making a difference in bringing Russia to any kind of negotiation at all? Is it possible to find a sanctions package that would do that, Max?
There is absolutely no doubt that tougher sanctions, sanctions are already making a serious impact on the Russian economy, but not enough. And what everybody I respect agrees is that in order to have a hope of bringing Putin to the negotiating table, we need a mixture of tougher sanctions and also increased arms deliveries to Ukraine. Now, the sanctions at the moment are incredibly porous. Since Trump came in, he has eased many of the sanctions. It is now possible for Putin's friends, Russian oligarchs, to do major business in the United States with no chance at all of facing any serious trouble inside the United States. So Trump's made that easier. In London, I'm sorry to say, I remember being shocked when a very senior Bank of England official said to me years ago, well, of course, London is the money laundering capital of the world. Not much has changed since he said that to me. But today, the Russians can still move huge sums of money through London because those sums are too important to turn away. And I'm afraid we're all hypocrites about this. We all keep saying that we're determined to sanction Russia, and yet sanctions are incredibly porous. So if Ukraine is to be saved, and let's be in no doubt, Ukraine is in a very bad spot at the moment, with Putin piling on the pressure to try and get a victory this year. We've got to get tougher with Putin. We've got to give more support to Ukraine, and today it's not happening.
Max, thank you so much for joining us. Good to speak to you. Bloomberg opinion columnist Max Hastings, with thoughts then, Valerie, on where the NATO defense narrative goes from here.
Yeah, now let's look ahead to some catalysts later today. U.S. Federal Reserve is going to release results from its annual bank stress test after the bell. Bloomberg's Charlie Wells is here with the preview. Charlie, what is the outlook for these results?
So look, Val, if history is any guide, all of the 22 banks that have been subject to this testing will probably pass. There really hasn't been a notable failure in these stress tests since 2018 when the U.S. arm of Deutsche Bank failed. And so what tends to happen is they pass, they finally get some clarity on what their capital requirements are going to be, and then they can start doing the things that, of course, investors love, which is talking about dividends. Now, Bloomberg Dividend Forecasting has been thinking about this, has been projecting this, and they actually see U.S. banks in the third quarter increasing dividends by 7%. And in a lot of ways, that's because these U.S. banks are incredibly well capitalized, right? If you think about J.P. Morgan, CET1 ratio is, or CET1 surplus is $56 billion, 3 times more than Bank of America. So a lot of capital.
And briefly, Charlie, how is the Trump administration looking to change the stress testing then?
They're looking to lighten it, right? So Michelle Bowman, recently installed as a top banking regulator, they're looking to get more transparency. That's what banks want. That's what a lot of investors have been thinking would happen earlier this year. It's taking a little bit more time, but it's looking like it's moving in that direction.
Okay. That's enough stress for a Friday.
Let's move on from the stress. Charlie, great stuff. Thank you very much indeed. And talk about what we've got coming up over the weekend. Anna's going to see the F1 movie.
Yes, I am.
She's very much looking
I'm not
forward
doing
to
any of the other things that are on this graphic. I'm not going to Jeff Bezos' wedding or Glastonbury.
Or the Austrian Grand Prix.
Or the Austrian Grand Prix. Or
there was
the
some.
Roskilde Festival.
Anna's been talking about F1 all week, and everybody assumed that she was going to the Austrian Grand Prix. It turns out she's going to the cinema.
My bar for excitement seems to be pretty low, basically. A night out.
Glastonbury? Anybody going to Glastonbury?
I'm too old for that.
Oh,
I am
no.
looking forward to these photos from Jeff Bezos' weddings, though. You know, Americans abroad love to have it up.
Venice is
Charlie's
enjoying
familiar with
it.
that.
Venice is loving this experience.
Well, they hate it and they love it. I kind of love the drama on both sides, right? You've got these protesters kind of predictably not happy that a billionaire is coming and basically renting out their town. But also you've got all these celebrities coming, and it looks like it's a fun wedding. And also, Venice is a place where people have extravagant excess. They've done it for centuries.
Yeah, but there have been protests, haven't there?
Yep. Venice is one of the epicenters of the over-tourism story.
Yes.
And the resistance and the pushback that we are seeing in a number of European capitals, Barcelona,
Did they
Venice.
rent out the whole city?
See, I'm glad you
Kind of felt like it.
I'm glad you took us there, because I was struggling for a news link, and I was going to take us back to US taxes and OECD tax, and that's not really.
I can take you back to the dollar if you really want. Americans turning up with lots of dollars.
But the revenue is, I think it's going to be something like 40 million euros for this town. The politicians really love it. The businesses love it. There's all this stuff about caterers getting a lot of business from this. This is beneficial for Venice.
Let's hope it doesn't sink.
That's the American point of view. Yes.
From the weight of all the large Americans on it, Anna, there we go.
I did not say that, Valerie.
We can say that. Val, you and I can say that.
They're on safer ground.
The movie's going to be great. So
Yes, exactly. That's why I keep my excitement to low levels. Thank you very much to Charlie. Thanks to Val for joining us this morning. That is it for the opening trade. The Pulse is up next. European equity markets continue to move higher. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. Commerce Secretary Howard Lutnick tells Bloomberg a trade agreement has been signed with China with imminent plans for another 10 major trade partners. The U.S. says it will drop its Section 899 revenge tax threats on foreign investments after reaching a deal with G7 allies. And Nike gets a boost as the sportswear brand says its year-long sales decline is starting to ease. We'll bring you the pre-market move shortly. So we've made it to Friday. That's the good news. The other good news is that when you look at markets, there's a little bit of stability. So we'll check your markets every 15 minutes. Look, stocks are definitely advancing on hopes of this trade deal. There's also hope that the Fed will cut. Expectations are rising that the federal interest rate cuts this year will be larger than expected. Now, I guess the market is pretty much riding high on hopes that inflation is cooling and that the Fed can start cutting soon. But some also warning that if growth does not pick up or earnings disappoint, the rally could run out of steam pretty fast. Now, S&P futures gained some 0.2%. We also always look at oil, given what happened over the last 10 days, and then European markets. You can see quite a lot of green on the screen. It has been a bumpy 2 weeks, but for the moment, they're climbing some 0.6% on aggregate. We also had data showing that French inflation stayed well below the European Central Bank's 2% goal. And then yesterday, NASDAQ reaching a new high. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Trump's tariffs and taxes dominating the news agenda. We'll have team coverage of trade deals and the so-called Big Beautiful Bill. We'll find out what markets make of it all with the BlackRock's Alex Brazier. But first, the latest on trade. U.S. Commerce Secretary Howard Lutnick says Washington and China have finalized the trade truce. Well, the deal sets out terms from earlier talks, but still depends on future actions.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Well, that was Howard Lutnick speaking to Bloomberg yesterday. We're now joined by Ross Matheson, our EMEA news director, and Oliver Crook, our Europe correspondent for The View from Brussels. So thank you both for joining us. Ross, what do we know about the China deal?
Well, it's basically the deal that you can call it a deal or maybe more a framework, an understanding, an MOU, but it's what was agreed to in Geneva. We had confirmation a short time ago from China that they have indeed signed this framework understanding, confirming what we heard, obviously, from Lutnick overnight. But again, it's the broad framework. So it's about the China agreeing to send rare earths into the US easing off a little bit on things like ethane. We know that ethane's actually being shipped but not allowed to yet disembark in China. But China wanted that because they want to keep up their production of things like jet engines. So we've got the broad framework of that, but a lot of the tough stuff, as we know, was not discussed in this understanding and has been pushed down the road, be it all the things that flow into the relationship as well around fentanyl and so on. And so it's an initial framework. Perhaps it's a sentiment moment for markets and shows at least the relationship being on a bit more of an even keel. But as we know, with the US and China, things can shift very quickly. So we have a deal, we've had these before, and then things have fallen apart within a matter of months. So it really depends on actually tangibly seeing the US and China now do what they've said they've agreed to do as part of this. That becomes the basis for further talks.
Ali, on the European side, so EU leaders currently meeting in Brussels, what are they saying about US trade negotiations?
Yeah, Francine, if we have a sort of idea of what the framework looks like with China, we have basically no idea what the framework looks like at the European level between the trade deal between the U.S. and the EU, which is pretty concerning given that the deadline that the Trump administration has imposed is about a week and a half away, July the 9th, and that is the date that theoretically Trump will impose 50% tariffs on that $1 trillion trading relationship between the EU and the United States. The conversation around the table here in Brussels among the member state leaders that gathered yesterday to meet right after that NATO meeting was basically how much asymmetry in this trade relationship are they willing to accept. They do believe that it's going to be unbalanced. They do believe that what the United States is asking for is unfair, but there's a question about how pragmatic they want to be and trying to gauge what Trump's appetite is for escalation. So I'll just quote to you from the new Chancellor of Germany, Friedrich Merz. This was his first EU leaders meeting here in Brussels. He says it's better to go fast and simple than slow and highly complicated. We need to reach a result quickly. We've all agreed to that. There is no disagreement there at all. We've also heard similar things from our reporting from Giorgia Meloni in Italy. Macron has been a little bit more reticent to sign on to this because he doesn't believe, and everybody's playing Trump psychology, that if you give in to everything to Donald Trump, that actually will make the Europeans weaker longer term in negotiations. So I suspect what may happen is in the next week and a half, you potentially get some kind of framework, but you're not going to get that final trade deal. I wouldn't be surprised if it's going to require a flight from Brussels to Washington, D.C. on the part of Ursula von der Leyen to talk directly with the Trump administration, because at this point, any sort of details of that trade negotiation are still pretty abstract.
And finally, Roz, what do we know about this revenge tax?
Well, that's right. So there had been a lot of talk about the US imposing a revenge tax. This is the US wanting to take ownership of their tax structure, the feeling that they've ceded too much, for example, to the OECD over the years, and threatening, what they said was countries that had discriminatory taxes on US companies. The concern was, in turn, you're going to deter companies, obviously, from investing in the US as a result of putting production in there, which is what Donald Trump actually wants, his companies bringing production to America. We can see the market reaction telling us that perhaps people didn't really seriously think this was going to happen. It was also flagged as sort of a slow death of this in a way of 899, because you can see in recent weeks the G7 saying we're here, let's agree on this. And so not entirely unexpected, but it does obviously provide some sense of relief potentially for companies who are looking at the US.
Thank you both for joining us. There's a lot going on, and beautifully put together. Ross Matheson, our EMEA News Director, and Ollie Crook in Brussels. Now we're joined by Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Alex, there's just a lot to unpack, and it does feel like the financial system just continues to change, and it's unclear where we end up, either on the beautiful bill or things with taxation. So how do you construct a portfolio given all the uncertainties?
I think there's two really big things going on underlying all this. The first is that the stock-bond correlation now is much less reliable than it used to be, sometimes unhelpful, much more positive. And that's because we're in a world of looser fiscal policy. You alluded to the one big beautiful bill. We're in a world of trade restrictions, which means openness declining. It means more upside inflation shocks. We'll see more of that in the US over coming months. For both those reasons, bonds are just a less reliable hedge for stocks. And as a result, portfolios are shifting both from sort of 60-40 to be more 50-30-20, as you get more private markets and the investable universe expands. That's great for diversification too. But also within the public markets sleeve, people looking much more now at strategies that are market neutral, uncorrelated with the broader market, uncorrelated with broad factors, and actually looking to exploit the relative value trades that are emerging in this period of structural upheaval.
And would this be basically the private market also component? Because you also, the correlations have broken down, right? If you look at over the last 3-4 months, the way equities and bonds have been doing, you kind of had to always take a double take because they were pulled by different forces.
That's right. And I mean, at any point in time, the correlation is surprising right now for different reasons. But I think two things are going on, right? So one is put in private markets. The investable universe has expanded, and those asset classes in private markets are typically less well correlated with public markets. So that actually acts to diversify the portfolio, move the kind of risk-reward trade-off back closer to where it used to be in the good old days. And then within the public market sleeve, to look to these strategies that are more market neutral at the same time.
Okay, I like the 50-30-20. How much do you worry about a debt crisis or actually a U.S. auction going badly?
We've seen a few kind of flare-ups of that over recent months. I think the U.S. fiscal position is a big story. We're not in a position where the primary deficit is going to be closed. As the bill passes through the Senate right now, we're seeing how difficult it is to get all of the spending cuts that were penciled in by the House. And actually, that means that over the long term, we expect more upward pressure on the long end of U.S. yields. Much prefer the belly of the curve because there are signs that the U.S. economy is slowing. It's pretty resilient, but it's not immune to what's going on. And actually that means we will get some Fed rate cuts this year. The belly of the curve looks reasonably attractive to us. We expect it to steepen over the long term. But I would also add that within fixed income, there are relative value opportunities looking to Europe. Because the other thing that's happening in portfolios is investors, particularly in Europe, are beginning to shift capital away from the US to Europe. We've seen the implications of that in the dollar. We've seen it in exchange-traded flows. And when we survey investors, they're still looking at repatriating capital towards Europe. Same is also true of US investors who are beginning to see more opportunities in Europe.
But Alex, when you look at the Fed, I mean, there has been a little bit of a repricing in cuts, also because there were rumors that Donald Trump would, nominate someone who would effectively be a shadow Fed chair from September, October, and we know how he stands. So it's, it's unclear, I think, what the market is really looking at.
Well, I think this story's been bubbling around for quite a while, but I think it's a reflection of two really underlying forces. The first is that we're now in an environment where stock-bond correlation is less reliable, more inflation shocks, and that means the central bank's facing more occasions when it's facing a difficult trade-off between how quickly you return inflation to target and what kind of economic pain you're willing to tolerate. And that's something that politicians want to have much more of a say in. So it's a different world. And secondly, we're in an environment of looser fiscal positions, and that means typically you prefer lower interest rates. Now, regardless of how that plays out with personalities, it means we're in a regime now of more inflation uncertainty. Inflation will be, positively surprising more often than not, and it'll be brought back slower than perhaps it used to. It's a very different environment, and that means, it, again, reinforces not liking the long end, and it reinforces reworking portfolios to be much more diversified.
Is stagflation a real risk?
I think when we talk about stagflation, everyone immediately thinks of the 70s. I think what we're talking about here is inflation going up a bit and being generally a bit higher in this fiscally loose and less open global trade environment, and growth being a bit weaker. So we're not talking about sort of 1970s stagflation, but we're just talking about those two things going in opposite directions.
But that would make it very hard for central banks. Is there a scenario where actually central banks just can't get to grips with some of the scenarios that are thrown at them?
No, I think actually it's a question of how quickly they seek to deal with inflation shocks. Do they, when inflation rises, immediately declare it to be transitory, one-off, no need to respond? Or do they take perhaps a tougher stance and react to things that should ultimately be transitory, but they want to bring it back quicker? And I think we're probably less in that latter camp and more in the slightly more tolerant camp. Inflation will ultimately come back, but actually it means that on average, you're looking at 3% inflation rather than 1%.
But there's also this mismatch between what surveys and what people think that the economy will do and what's showing up in the data. Is this a mismatch that, is it like a lagging 3-4 months delay, or it could also not come true?
I think it's two things. And we saw initially around Liberation Day, very sharp falls in some of the softer surveys, and the hard data hadn't moved. Now the soft surveys have recovered quite a lot, but the hard data have started to slow, and we think we are seeing in some of our high-frequency, kind of systematic big data signals, more signs of slowing in the labour market, some easing of pay growth. And you look at H1 as a whole, the US economy has grown at a quarterly annualized rate about 0.7%. It's not bad, but it's nothing to write home about. And if that carries on through the year, that's an environment where the US economy has slowed under the weight of uncertainty.
Alex, how do I think about AI transformation and, again, how that filters through your asset allocation?
Yeah, I think two things. The first is that as far as the mega caps go, they've had a great run as, DeepSeek came along in January, but it then became clear that the capex plans of these firms were still very strong and the earnings potential of these firms still very strong. But I think the second point is more important, which is that this trade likely to broaden out over time into who is able to harness AI and adopt AI to really increase productivity. And this is where getting to grips with deep big data signals of really which companies are able to get to grips with this, raise productivity, boost earnings, who are going to be the winners, who are going to be the losers. And I would say it's proved more valuable recently to be able to get ahead of thematic rotations in the market. On our calculators, about 3 times more valuable than it used to be. So we're seeing much more interest within equity sleeves of these kind of rotational strategies that are trying to get ahead of these rotations in the market around these themes.
But is it too soon to say? Because you don't even know who the winners... I mean, do you have a clear print, actually, of the kind of transformation that we could see AI, that you can start making calls on who will do it
No, and that's why I think it's got to be very precise, very company-level insight, and it's going to take a lot of data to do this. We're finding that the number of signals you need to get ahead of these rotations has gone from kind of 40 years ago to about 1,000 now, right? Now, the data sets have expanded and the technology's expanded to do it, but in this systematic analysis, you've got to get really, really granular.
Okay, your most contrarian call, given it's Friday and we're all looking at the Bezos wedding.
And you don't want me to talk about the Bezos wedding. You don't want me to take on the Bezos wedding. I think actually not quite liking, but everyone likes Bunds right now. Actually, given the scale of the fiscal expansion in Germany, even with some repatriation of capital that's going on back across the Atlantic towards Europe, actually Bunds don't look that attractive. There are opportunities. We like gilts, not so much Bunds right now. And don't stay away from the US long end.
Okay, so good. Thank you so much. We'll talk about Bezos afterwards. Alex Brasher, Global Head of Investment and Portfolio Solutions at BlackRock. Now, coming up, has Nike just done it? See what we did there? We'll dig into the sportswear giant's earnings rebound as shares soar pre-market. That's next, and this is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back, everyone. Nike shares surging pre-market thanks to a brighter outlook on hints that Chief Executive Elliott Hill's turnaround plan is starting to work. Now, sales still expected to dip this quarter, but less than anticipated. We're joined by Sonia Wind, our consumer reporter. Sonia, thank you for joining us. So is this really the start of a turnaround?
It could be the start of a turnaround, I would say. I mean, it's clear that the quarter was painful. It was one of Nike's worst performances in recent years in terms of the quarters, but it was better than Wall Street has feared. So that also explains the stock reaction. And the CEO said that the worst may be over now and that his new strategy is starting to improve the performance of Nike in the coming quarters. What he's doing is to basically undo the missteps of his predecessor. So that includes improving the relationship to wholesale partners again, because Nike's direct-to-consumer strategy backfired and it lost some market share and shelf space to rivals like On and Hoka. And he's also clearing out excess inventory to make space for fresher and new designs. In addition, he's also doing some partnerships like the one with Kim Kardashian that could also help bring shoppers back to the brand. So it looks like we could be at the start of the turnaround, but of course we have to see like how that's going to continue and whether these changes are taking a hold in the coming quarters.
So, Sonia, what about the potential impact of tariffs?
Yeah, so that's definitely a big challenge, not only for Nike, for many sports retailers. Nike has said that it expects a $1 billion headwind in terms of costs in the fiscal year of 2026. So his strategy is to reallocate the production away from China to other countries. Nike currently produces around 16% of its U.S. footwear in China, and it plans to bring that down over the coming quarters to like a high single-digit percentage rate. So it also looks at how to save costs on the corporate side of things and to what extent it can pass on some costs to consumers, which is always a bit of a tricky balance to strike. But the main priority remains to reignite brand momentum. So he's trying to do that with a renewed focus on core sports areas, especially running. And we've also seen some good early signs for new running shoes, which have seen a warm reception. And upcoming launches like the Air Max Phenomena has seen some online buzz going on. So if that energy also translates into sales, that would, of course, also help to cushion the impact of tariffs a little bit.
Sonia, thank you so much. Sonia Wynn there with the very latest on Nike. Now, it's been another bad week for the dollar. It slumped and reports that President Trump is considering naming Fed Chair Jay Powell's successor before his term ends. Now, traders took that as a sign that interest rates could be cut sooner than expected. Now, we're joined by Themos Fotakis, Global Head of FX Strategy and Emerging Markets Macro Strategy at Barclays. Themos, as always, thank you so much for joining us. I mean, there's just a lot going on, and dollar kind of underpins everything. What's your dollar call?
We're generally thinking that there may be still a little bit of dollar downside in the near term and maybe some dollar recovery 12 months out, basically.
So what's your, overall, would you play the dollar against?
I think if indeed we are in a place where money's flowing out of the U.S. and into other locations for diversification, emerging markets probably stand to win the most. They offer carry, they offer a better growth momentum, and they also are small enough for these flows to have an enormous impact. And they're now cheap relative to things like the euro.
I like your, the insights that you send around. And there's one, dollar hedging, a trend or a fade. I mean, it just feels like it just nails the main question. Which one is it?
Well, first of all, it is the main question because this is a flow-driven market, right? You have seen narratives come and go, 899, fiscal, U.S. growth story, and the dollar just keeps selling regardless of the news, right? So it's pretty clearly a flow story. I would say that based on our analysis, you can definitely see under macro scenarios hedging flows taking euro dollar to something like 120 or slightly above. And that's the upshot of 3 models that we've deployed around this. However, I'd like to say that the higher we go from here, the risk reward worsens. A, because it becomes a very flow-driven thing, momentum, flows drive flows, which is always a risky location to be. Yeah. And B, because a lot of this hedging is not true hedging in the sense that people are not returning money to their local currency. Right. They're just buying the euro, which is adding to risk as opposed to reducing risks.
So interesting. What's your trade outlook? I mean, we started the show talking about, U.S.-China, but also the EU response to what the U.S. is doing.
I think that we are in a period of time where people want to reduce tensions as opposed to build up. So generally speaking, we don't expect to return to a kind of a flare-up like the one we have in April. Okay. However, particularly because of tariffs, but also because of the enormous front-loading that has occurred before tariffs, trade is likely to slow in the months ahead. basically, right? And that should have its own effects on economies.
When you look, I mean, look, there's a number of questions, whether it be stagflation or actually whether there's going to be a shadow Fed chair, which frankly has moved the markets even before confirmation or denial of that. How does that, feed into your narrative?
I think it anchors people's Fed expectations. Even if you get better data, people will always refer to next year as the point of time of chair change. That is going to stay in place for some time. Having said that, Senate will also ultimately need to confirm that person. And that probably leads you to someone who's a little bit more standard sort of like candidate with Fed background as opposed to someone who's a multi-standard deviation kind of a candidate, which should be good ultimately.
I quite like that. More of a standard than a multi-standard deviation kind of guy. I mean, I think that's like the new coined phrase. Themos, how do you look at euro?
Euro at the moment is very expensive. If you look at the broad trade-weighted euro, it's the highest it's been in history, basically, right? And this is because a lot of emerging markets have cheapened against that. Euro-dollar doesn't paint the full picture. Euro crosses have risen a lot. This is because it has benefited as the anti-dollar from all these hedging flows. Yeah. For now, it's the only game in town. But the higher we go, the risk-reward is less good. What we have recommended is selling the euro against a multitude of currencies in emerging markets, in majors, carry, and so on and so forth.
But does Europe have an inflation problem to the downside?
Yes, to the downside. I think tariffs will probably add to that.
Okay, so there's a little bit different to actually what we're seeing in the UK. I don't know whether there's a bit more stability in the UK or whether, again, it's a small open economy, anything could happen.
Relative to expectations, I think the UK has proven to be a lot more stable. I cannot think of any other obsession in markets that has lasted for so long than people trying to see or wait to see the UK economy roll over. And the UK economy keeps printing decently. Not great, but decently relative to expectations.
Which means that but this is because of stability or because of just the way that the capital market structure is put in place or what the Bank of England has done?
Also the fact, all of these things that you mentioned, but also the fact that the shock that you've had to the UK has been a supply shock as opposed to a demand shock, basically, right? Which has kept certain sectors artificially sort of like stimulated in terms of wages, which is what Hugh Pill has also spoken about, right? The stickiness of wages, which has, again, fed back into the Bank of England and the price outlook, etc.
So I don't know what to do with renminbi, but because it's a U.S.-China trade kind of day...
Join the long queue.
It's unsure, right? I mean, it could go either way.
I think one just needs to look at Euro-China. Main trading partner trading at many multi-year highs, basically, right? Either the renminbi at the moment is too cheap or the euro is too expensive. But these things cannot be going apart forever.
When do we know? I mean, it's just data. Yeah, it's I guess data points, right? Or does it really depend on U.S.-China trade?
I think it does to a very large degree. So we probably need to see the shape of deal, the shape of other deals in the region, whether we have a broader sort of like Asia flare-up, and then how far the euro goes in this overshoot.
So interesting. Themos, I really enjoyed that. Thank you so much for coming on.
Thank you very much, Francine.
Themos Fotakis there, Global Head of FX Strategy and Emerging Markets Macro Strategy at Barclays. Coming up, we talk tech, VC investing, and the race to achieve artificial general intelligence. That'll be coming up next. We speak to Matthias Lungman of course, Moonfire. We'll ask on defense. We'll talk about the EU AI Act. What needs to be done more to help some of the small startups, but also venture capitalist money coming into some of the sectors. That's next, and this is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. U.S. Commerce Secretary Howard Lutnick tells Bloomberg a trade agreement has been signed with China with imminent plans for another 10 major trading partners. The U.S. says it will drop its Section 899 revenge tax threats on foreign investments after reaching a deal with G7 allies. And Nike surges pre-market as a sportswear brand says its year-long sales decline is finally starting to ease. Now let's also turn to the world of tech. The AI race shows no signs of slowing down, with the pace of innovation continuing to accelerate and valuations continuing to climb. So who the winners and losers will be, though, is a key question for investors. Well, I could not be more happy to be joined by Matthias Lungman, founder and managing partner of VC firm Moonfire Ventures. Matthias, thank you so much for joining us. I mean, there's a million questions on AI because it's difficult to make sure that you don't fall into the hype, and that you figure out who's the good AI and the bad AI. So how do you do it?
Well, I mean, ultimately, AI is changing software across the board. Ultimately, we are looking to build the next generational company that's taking advantage of this incredible opportunity. We're building intelligence throughout our software. And so we're having a massive step change. We're having what I call just a whole new generation of software that's being built that's going to probably replace most of the existing software that we have out there today. And there's a whole new way of building companies as well that's coming into play. And I would say, the company building that we're seeing today is kind of as big of a change that we've seen since the start of the internet. So today, you can be a 10-person company and build a $100 million business. And that was kind of like a fantasy before. But now we're seeing that as a clear trend, a capability where you don't need hundreds of people and you don't need millions of dollars. But what you do need is capability, ability to utilize AI in the most effective manner and create the next generation of companies.
Matthias, when you look at the EU AI Act, there's a lot of people saying that this inhibits startups. Do you agree with that?
I mean, I would say in general, I feel for politicians as well. They're looking to try to find solutions and protect customers and the population out there. But I think we have to be really careful of having a kind of alarmist approach where we have blanket decisions where we are trying to solve all the problems today. We don't know where AI is going to go. It's going to be an iterative approach. And, the pace that we have actually had change within AI and what we're able to do today is already significant. But we haven't seen a fundamental change in our society and economy and so on. So I think we should be a little bit careful and take it step by step. That's what I would say to politicians, think about it in the car industry. It took 40 years to build out safety standards, and we just need to be a little bit pragmatic about the whole approach.
Matthias, can you talk to me a little bit about VC fundraising? It's been hard. Is there now any relief?
You mean for the actual funds raising new capital? Yeah, look, I think it is really hard. It's been 3 years plus where, people are questioning the sector, but there's been, as you know, a bigger sort of overall shift, right, in terms of people thinking about the, where they're going to be placing their next kind of their bets. But to me, the industry itself still is the cutting edge industry, and it is also, the approach where we're going to have these outside outcomes happens in venture. So you can't look at it as an average or a median. You have to look at it as, are these funds capable of doing things that are extraordinary, just like our companies? So I think if you want to look for extraordinary companies, you need to look at extraordinary funds as well.
Do you think there will be some kind of consolidation amongst VC firms?
That hasn't happened before. I think that's kind of hard. But what is interesting is that there has been a bit of acquisitions, which has surprised me. But I think structurally is not really how it works. I think it's going to be that companies disappear, and but at the same time too, there is lots of capital still on the sidelines. And I think venture capitalists are also being more careful. They're not going after just the good companies. They want to go after the outstanding companies. That's the next kind of benchmark that's required.
Because when you look at defense, this is like the big industry that Europe is, betting on, is talking about. But what, in your views, are the difficulties for startups in this industry?
Yeah, look, first of all, this could be a really interesting moment for Europe because we have the convergence of, the geopolitical requirements and alignments, but also technology and innovation. And so I think Europe has a really good place to play in here. And to me, I also see a bigger trend in terms of, if you look at the companies we've invested in, where maybe they're not directly defense companies, but they have kind of dual purpose. And so we're investing in companies, for example, creating other forms of AI or frontier robotics, cybersecurity, but at the same time too, they're being used for defense purposes, even though that wasn't our original intention. But it's exciting to see that happen, where we're building up defense capability at the same time too, driving innovation. Ultimately, Europe needs to continue to create these mission-critical businesses and then take advantage. The founders, I think, are going to take advantage of the fact that we are a stable, reliable, neutral party that is an alternative, and probably, for those out there that, want to have choose between the U.S. and maybe China, we will be that alternative.
What are you most excited about, actually, at Moonfire? I know there's a lot of uncertainty. It's trade, tariffs, wars. There's interest rates. But if we finish on maybe a positive note, what do you expect in the next 12 months?
I think in general we are in this unique moment in history where we're having a super cycle, AI super cycle, that's redefining how companies are being built, and we're having a big step change in capability. If we compare this to the Industrial Revolution, where we pushed the boundaries of what was capable of human labor, now we are doing that with intelligence. And suddenly now we are building intelligence and actually scaling intelligence through AI. And we have never been able to do that before. I mean, I'd like to end with, Sam Altman talks about how intelligence is the most powerful force in the universe. And now we're able to scale it, which is really exciting.
There's a million questions on, artificial general intelligence, which means different things to different people. Do you worry about humans losing critical thinking?
Look, I think it's always going to be part of human innate requirement to be able to do that. We haven't stopped ourselves from applying that on a day-to-day basis. So, no, I'm not worried about it. I think curiosity is what drives humans, and I think what makes us unique as beings. So, if anything, it's going to leverage it. I think we're going to be able to push the boundaries. It's also democratizing it. There's more people who are going to be engaged in this kind of activity. So I think we're going to be more capable, more productive. So I'm extremely positive about the future.
So interesting. Matthias, thank you so much for joining us today. That was Matthias Lungman, a founder and managing partner of Moonfire Ventures. Now, the Chinese tech sector has been on a roll since the arrival of DeepSeek in January. The Chinese AI startup stunned the world with a language model that claimed to match or outperform Western rivals at a fraction of the cost. Now, with state backing and massive investments fueling China's AI ecosystem, the country is fostering a new generation of startups in search of the next DeepSeek. Well, Bloomberg's Annabelle Jewelers report.
The number one factor that will define whether the United States or China wins this race is whose technology is most broadly adopted in the rest of the world.
It's not just a matter of building more sophisticated models. Competition between the US and China on AI is expanding to standards, governance, infrastructure, and more.
It's very hard to say how far ahead we are, but I would say not a huge amount of time.
Any lead the US has is eroding fast, despite restrictions on exports of advanced semiconductor technology.
The Chinese competitors have evolved and advanced greatly over the last year, doubling, quadrupling their capabilities every year.
Washington is shifting from a strategy of China containment to international bloc formation and promoting US-led tech ecosystems.
When it comes to the rest of the world, we want American AI stack, starting from the GPUs to the models, to everything on top.
Pushing countries to build on such frameworks will not be easy, even with the Biden-era AI diffusion rules scrapped.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
Chinese tech now presents an alternative to dependence on the West, with AI leaders like DeepSeek and Alibaba going open source to build quickly and at scale. That's putting the spotlight on flows of talent and money.
American venture capital funds funding Chinese AI, is that in our national interest?
Like Washington, Beijing wants to shape global norms for the use of AI and sees an opportunity in the global south in particular.
Going forward, China will open its doors still wider to the world.
Yet the choice of US or Chinese AI technology is unlikely to be binary, at least for now. Governments have navigated the twin poles of power for years and will likely keep doing so until an obvious reason emerges to pick a side.
Now to some other tech stories making news. Shares in China's Xiaomi have hit a record after strong initial orders for its new electric SUV. Now the YU7 is billed as the direct competitor to Tesla's Model Y. The company says it received 289,000 orders in just 1 hour. Bloomberg understands that Omid Afshar, a powerful executive at Tesla and one of Elon Musk's closest confidants, has left the company. Now, the latest high-level departure during a volatile period for the electric vehicle maker. News of the exit has circulated internally among some employees in recent days, though the reason for the departure is not immediately clear. And Apple has offered to overhaul its App Store after being given an ultimatum by EU antitrust watchdogs. It's proposing to make it cheaper and less onerous for third-party developers to direct customers away from the Apple ecosystem to make payments elsewhere. Now, Apple was fined 500 million euros in April for alleged violations of the Digital Markets Act, which it says it's planning to appeal. Now, more of our interview with the U.S. Commerce Secretary, Howard Lutnick, on tariff deals. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Well, back to our top story. The U.S. says it's finalized the trade truce with China. President Trump has hinted that an agreement with India may follow, but he's warned that Washington will not cut deals with every country.
Well, we just signed with China yesterday, right? Just signed with China. We have everybody. We're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way.
While U.S. Commerce Secretary Howard Lutnick has told Bloomberg that deals with 10 other major trading partners are imminent. Here's more from our interview.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago. President just said it just the other, I don't know, 15 minutes ago. And then he also suggested that we are, of course, at the very close finish line with India. Of course, the way these deals happen is their prime minister and their parliament have to approve it, and the president likes to close these deals himself. I mean, he's the deal maker. He loves to close it. I think we have deal after deal after deal. The president's going to make his calls. He's going to decide exactly the finishing touches on them. And then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements with different countries, right? There are countries with huge deficits. There are countries that are balanced. We're going to set that all up and get that ready for July 9th.
So it sounds to me, Secretary, and correct me if I'm wrong, as I listen to you, that we either get 88 deals announced in the next 2 weeks, or there's going to be action one way or the other by this administration that July 9th will be conclusive. If there's no deal, here's the new reciprocal tariff. Is that right?
Of course. So what we're going to do is we'll announce some deals, but basically the deals we're going to announce are sort of the head of the class, the structural spot in the line, and then all the other countries will fit behind those categories, right? So we're going to do top 10 deals, put them in the right category, and then these other countries will fit behind. So you'll have South American deals, and you'll have African deals. You'll have it all structured and set up, and that's the model how you do leadership, and we will put these people in their proper buckets on July 9th. So those who have deals will have deals, and everybody else who's been negotiating with us, they'll get a response from us, and then they'll go into that package, and July 9th will go forward. And as the president said, if people want to come back and negotiate further, they're entitled to, but that tariff rate will be set, and off we'll go.
That's the U.S. Commerce Secretary Howard Lutnick. Now, U.S. stocks again in record territory as optimism grows over rate cuts from the Fed. The Nasdaq closing to another all-time high, with the S&P also eyeing a record. Now, let's bring in Ven Ram, our MLive strategist. Ven, there's so much. First of all, thank you for joining us. But there's so much I want to ask you in terms of Fed expectations. But let's maybe start with outlook for U.S. stocks. Where do you see it going?
Morning, Francine. Thank you for having me. I think that, look, I mean, there is no question that, with stocks going from one high to another high, I think it's a question of time before we get another record close. So the question is where really we go forward from here. I mean, everyone knows that valuations are pricey, but how pricey are they? if you adjust the S&P's earnings for cyclical variations and for inflation, what you see is that investors are paying well over 36 times for each dollar of earnings in the index, adjusted for inflation, of course. To put that in context, it's the most they've been willing to pay for the privilege of owning stocks since the dot-com bubble. So I think that, when inflation-adjusted earnings are this low, especially in relation to real yields on 10-year bonds, I think it has historically been a sign of anemic total returns over the following decade. And, if you look at the correlations between the two, what it shows is that over the next 10 years, total returns on the S&P will be negative 1.5%. What that means is that, if you strip out all the dividends that investors are going to get between now and the next decade, they are going to face capital losses on their investments. So there's a huge warning from the markets, from the market's own history, that this is getting to be like a pack of cards waiting to collapse. Now, the markets have decided that tariffs don't matter, inflation doesn't matter, nor will the impact of tariffs on the economy. This is not a movie that may end well, but let's see how this goes.
So there are also then, growing expectations of Fed cuts, but it's unclear to me whether this is just because of speculation that there could be some kind of shadow, Fed chair figure that could sway or push Jay Powell.
Absolutely. I think that the markets are fearing that, that Trump may nominate someone as the next Fed chief well before the time is due. And I think that fear has caused the markets to price in 2.5 rate cuts by the end of the year, to about 2 rate cuts earlier before all the speculations started swirling. Now we get another edition of core PCE this morning, and that is expected to show that a slight acceleration. Now, really, if you look at the data, Francine, what we have seen is that core PCE has averaged around 2.7% this year. That is not, of course, consistent with the target of 2% that the Fed is seeking. So the Fed is going to take its time, and nothing that we have heard from Powell in recent days suggests that he's willing to accelerate the pace of rate cuts. So 2 rate cuts up from here seems about right, especially in the context of an economy that is still solid and the tailwinds are still holding the economy aloft.
Ven, thank you so much. Ven Ram there from our MLive team. I would urge also everyone to go and read Ven's great pieces that we have on the Bloomberg terminal, but also on social media. Now, to some other stories making news today in state-run media, reports that Iran's foreign minister as saying no agreement has been reached on resuming negotiations with the U.S. Now, the statement comes after U.S. President Trump said during the NATO summit at The Hague that the two sides would talk next week. Now, Trump says U.S. strikes on Iran's nuclear facilities had obliterated them, though an early American intelligence assessment says Iran's nuclear program had only been set back by a matter of months. And Bloomberg has learned that Andrew Cuomo has no plans to drop out of the race to become mayor of New York City ahead of today's deadline, despite losing the Democratic primary. Now, that means his name will appear on the ballot in November as an independent. The former New York City mayor, Michael Bloomberg, the majority owner of the parent company of Bloomberg News, has endorsed and contributed to the Cuomo campaign. Meanwhile, the mayor of New York, Eric Adams, has relaunched his re-election campaign after Cuomo's shock defeat. And the U.S. Federal Reserve releases results from its annual bank stress test today. That's something to look forward to. They come as Wall Street banks and the Trump administration have been pushing for lighter regulation. Our Charlie Wells is here with a preview. Charlie, some people look at the Bezos wedding, others the stress test. What can we expect?
So look, I would be stunned if any of the 22 banks that are subject to these difficult tests fail them. That is not because they are easy. The tests so far this year have looked at a hypothetical scenario where these banks were subject to a severe recession, 10% unemployment, and a drop of about 1/3 in the prices of residential and commercial real estate. Difficult tests, but these banks over the past couple of years have been very successful in passing them. They are well capitalized. It's looking like they're in the same position now. And what that tends to mean probably is that after these test results are announced, they will be in a position to talk about buybacks and dividends, which investors love.
Charlie, how's the Trump administration actually looking to change stress testing?
Well, this is something that investors really thought would kind of come into play a bit earlier, where they thought there would be much more leniency here. They thought that there would be, very rapid buybacks. But what we are seeing is that we now have a new top banking regulator at the Fed. She's been in the position only a few weeks, and she's looking for lighter touch regulation. So that could have impacts on these stress tests.
Charlie, thank you so much. Charlie Wells there with the very latest on some of these stress tests. Now, onto a bit of fashion. Anna Wintour, the longtime editor of Vogue magazine, says the Condé Nast publication is seeking a new head of American editorial content. Now, for more, we're joined by our very own Tiwa Adebayo. Tiwa, I mean, this is a huge, huge deal, actually, in the world of publishing. And Anna Wintour is not stepping away from Vogue entirely, but what might the future of the magazine look like?
Well, Francine, yes, it is a really big deal. To put it in more Bloomberg terms, this is the equivalent of more than 2 Jamie Dimon tenures, so 37 years at the helm of American Vogue. But what it isn't is a retirement. She is, as of 4 years ago, the chief content editor for Condé Nast. She also oversees all of the Vogue editions globally for Condé Nast. So she's very close to that editorial content, and it's likely she'll continue to flourish in that role. This has been positioned as part of a broader set of changes that Condé Nast has made. A crucial one is the removal of that editor-in-chief title. So the person that succeeds Anna Wintour at the helm of American Vogue will not be the editor-in-chief, as she has been for 37 years. They will be the head of editorial content, reporting directly to Anna Wintour. So she's definitely not stepping entirely back from the Vogue brand.
I mean, it's interesting because it also goes to, points to the fact that a lot of these, legacy magazines have had to change the way that they push content out to consumers. What will her legacy be?
Well, her legacy at Vogue in recent memory is one of domination. You think of things like the Met Gala. She changed it from a very niche sort of society event to the cultural behemoth that we see today. Although it's important to remember that at times she's faced some complicated issues. She famously brought on actresses to star at the cover of the Vogue magazines and worked with Harvey Weinstein's team. There's a bit of checkered history to do with how she handled the Black Lives Matter upsurge in 2020. So it's not as glowing as perhaps we might all think. There are some complicated issues in her legacy, but she has certainly changed the face of publishing and the face of magazines, as well as the fashion industry.
Yeah, talking about fashion, I mean, all eyes on Venice. And this is not for the canal, but I think we're just getting, pictures, because some media have gone to town. There's live reporting from this, Jeff Bezos wedding. I mean, anyone who's who is there.
This is the wedding of the summer, and there are so many celebrities showing up. There are big wigs from across the board. This almost feels like a royal wedding, right? It's on that scale. When Oprah shows up, you know that it's on the scale of a royal wedding. But I have a question here, and it's, did it have to be Venice? I love Venice. It's so beautiful. There are so many other Italian cities. Trieste. Could they have been a little more original?
Trieste?
Yes.
No, Charlie, it has to be Venice.
All right.
Come on, if you have the money.
Bari, be a little more original.
For me, Venice all the way, but I appreciate you're thinking outside the box. We're definitely looking also at some of the protesters because of this Bezos Venice wedding. Charlie Wells and Tiwa Adebayo. Now, next week, of course, we're also live at the ECB Forum in Sintra. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do, And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. Trade truce. The U.S. and China confirm a trade framework has been signed off in recent days. And more deals. The Treasury Department is working with G7 allies to remove the so-called revenge tax proposed by President Trump. And Nike leads sportswear stocks higher as it sees a clear path to recovery ahead. 0.05%. That is how far away we are from this moment for a new all-time high for the S&P. Just given where futures are indicating up 1/3%, we will reach there. It did briefly hit that level yesterday, but didn't close there. NASDAQ 100, we are already at a record. The AI stocks, NVIDIA really leading us higher. When it comes to this Treasury market, we are snapping 7 days of yields declining. That saw the front end drop 25 basis points. Some pushback to that this morning. We're up just over 2 basis points. Your 10-year yield nearly 3 basis points at 427 this morning. Let's now get you some stocks to watch with your pre-market movers is Joe Easton. Hey, Joe.
Hey, Danny, it is all about Nike. I'm going to go with Nike because this is a US pre-market show. There should be Nike for all our British listeners. Nike shares are gaining today, but we have also got Amazon on the screen now. I think I jumped ahead. I'll take the fault for that one. Nike, we're up almost 10% after better than expected sales for the company, and also all about the outlook, really. They're saying that actually the sales decline not as bad as they had once feared. So that is lifting the stock today. We've seen Adidas or Adidas gaining here in Europe as well today, so keep an eye on sportswear. Then we will do Amazon because they are getting an upgrade over at Exane BNP Paribas, which reckons that AWS cloud business is going to join in all the frenzy, all the party around artificial intelligence, and they think that is the big Mag 7 stock that is going to beat expectations, if any do. Finally, we've got an upgrade for Boeing after a lot of the issues at that company, of course. A street high price target as well, 275 reckons a Redburn. That stock set to jump the highest on the street, that price target. So keep an eye on Boeing. We're up 0.9% at the opening of the pre-market trading. And as usual, check out the before the bell opening wrap on the terminal for a wrap up of all these news and more.
Joe, I just feel compelled to say, Adidas, you say correctly, it's a German company, but it's Nike. It's
Thank
Nike.
you. Thank you. Well, it's the quarterly debate. We have to do it every quarter. It's a tradition now.
We do. Lucky us. Joe, thank you so much. And we'll catch up with you later in the hour. And in just moments, we're going to be speaking to Victor Huart of BNP Paribas on cautiousness of investors. Later in the hour, Keith Lerner of Truist will be joining me as my co-host for the half hour. But first, Victor Huart of BNP Paribas staying alert even as global stocks hover near an all-time high. He writes, quote, investors are still very cautious even as we approach the highs. The main reason dips are so brief and shallow in both equity and credit markets is investors are still very cautious on the macro outlook and don't own enough stocks and bonds. Joining us now is Victor, Global Head of Credit and Equity Derivatives Strategy at BNP. Victor, that could be a really powerful tailwind. Should we get more broad participation? What could that look like?
So there is obviously a fair bit of good news. We're heading into what should be a positive earnings season, and there is some good news on trade. But I think, this very, very cautious positioning that you're referring to there, that really sets a pretty low bar for what will be perceived as good news. So, when we talk about positioning, there are ways of measuring it. And across both credit and equity investors, what's striking is that positioning is very, very close to neutral, kind of what it was back in 2023 when everyone worried about high rates and recession fears. That's not what you usually associate with the market that's near all-time highs. And, when you look at equities, U.S. equities for the past 4 weeks have actually had outflows. When you look at the credit market, investors have been absorbing very, very heavy volumes of corporate supply, but their cash balances are still unchanged. So this is probably a market that is still way too defensively positioned, and that should be a shock absorber. It should be a tailwind for markets and allowing us to test new highs.
As you say, Victor, something about that feels so odd. At a time where you have markets at an all-time high or just thereabouts, when the S&P 500 is priced something to perfection at 23 times, does it make you nervous then if we do get more participation in this and we do send equities higher, given all the risks that are ahead and the many macro deadlines approaching us this summer?
Well, yeah, I think the conclusion there is probably that we do need a bit more participation before we start to worry about that. And, when you think about why is it that investors are so gloomy or at least not bullish enough, I think a lot of it comes down to, can be seen in terms of how they think about the macro outlook. So if you look at Bloomberg data, consensus expects a lot of stagflation going forward. It expects U.S. CPI to average around 3.3% in Q3. It expects U.S. GDP to drop to 0.7% in Q3. And so does the Fed, and so does most people. And that is probably, pretty reasonable outcome. But it does mean that people are set up and prepared for bad news. And therefore, in order to really shock the market negatively, you need those news to be really bad. The hurdle for bad news is pretty high here.
Just how high is that hurdle? And Victor, I'm asking because July 4th, deadline for one big beautiful bill, July 9th, reciprocal tariff deadline, although we're getting some news on trade talks even yesterday. Then you get into CPI on July 15th. How do you set up for that? Is that a market you want to be defensively positioned for? Does that make sense?
So that CPI data will be probably very important. It's really the only proper inflation print that we get before the Fed. And obviously, as we know, within the Fed, there is a little bit of a discussion now whether the doves will be able to persuade the majority that we should go for a summer cut. That probability looks pretty low, but it's also not something that the market set up for, certainly not in credit and equity space. So that inflation print will be very important for how we perform for the rest of the summer. I think if you're looking for upside right now, chances are that U.S. tech is the best source of that. U.S. tech has a lot of important idiosyncratic drivers, specifically with respect to AI. And this could be the earnings season where actually software is the part of AI that gets most attention. But there are more mundane things. The US dollar has been very weak. Tech is the sector that sells most abroad and therefore benefits from that dollar weakness. And then there are some technicals that suggest that things can get very squeezy on the upside because of how the market hedges tech. So tech is probably the way to be positioned for upside going into the earnings season.
Victor, but it hasn't just been earnings, this past earnings, that's allowed stocks to power higher. The new highs, the trend higher also coincided with yields peaking in May too. To what extent is this rally just about falling discount rates as well?
I think it's certainly part of that story, and clearly there were fears, less about inflation, less about the Fed maybe, but more about pretty fundamental supply-demand issues in the long end of the Treasury curve. And not just the Treasury curve, but long-end curves pretty much everywhere else. What we're seeing right now, and I think the main reason why some of those fears have been alleviated, at least temporarily, is the fact that Treasury departments around the world are sort of leaning into those fears, and they are shortening the maturity profile of debt issuance that is likely to happen in Japan, that may happen in the US, it has happened in the UK, and absolutely, that is offering at least temporary relief on those risks.
Yeah, and Trump just yesterday in a press conference saying we'll probably just extend short-term debt. So rhyming exactly with what you're saying. Victor, so wonderful to speak with you. Enjoy the rest of your Friday and your weekend. Victor Hewart of BNP Paribas. Now let's get you some other top stories that are trending on the terminal this morning. Iran has denied that nuclear talks with the U.S. are scheduled to resume next week. Iran's foreign minister states that no agreement or arrangement has taken place for negotiations. President Trump said on Wednesday that the two sides would talk next week and, quote, may sign an agreement. Now, on the race for New York City mayor, sources say former New York Governor Andrew Cuomo has no plans of dropping out. That means his name will appear on the ballot in November as an independent. Cuomo lost to Queens lawmaker Zohran Mamdani in the first round of the Democratic primary. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, has endorsed and contributed to Cuomo's campaign. China's industrial firms saw their profits drop 9.1%. That is the most since October. Higher U.S. tariffs and lingering deflationary pressure has weighed on China's economy. Profits of automakers plunged 11.9% on the year. That's the worst drop since the first quarter of 2023. Coming up, more on China. The U.S. signs a deal with the country. Both sides confirm that there is a trade framework, but Beijing is vowing to review exports. We're going to have the latest for you on your Bloomberg Brief coming up next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
China said it has confirmed details of a trade framework while also reiterating that it will continue to review exports, writing in a statement. It will, quote, review and approve eligible applications for export of controlled items in accordance with the law. Joining us now is Bloomberg's Adam Blanford. Adam, the deadline for getting these trade deals done fast approaching July 9th. Looks like we have something of a deal for China.
Yes, good morning. It does seem like there's been an agreement. We've got both parties now confirming that. Although it's interesting that it was sort of announced, if that you could say that, without any real fanfare. Howard Lutnick there in your clip saying that the US and China had, as he put it, inked a deal. Remember, that was one that was negotiated in Geneva, and then they had to come back for another round of talks in London to try and get it a little more into gear. And this morning we've had similar confirmation from the Chinese, who have been saying that the progress has been made and that they're looking forward to trying to get some of these details into practice. Of course, signing a deal doesn't mean that everything has started to happen. The key sticking point, as has been for a number of weeks, is about Chinese exports of rare earths, which the US relies on for a whole host of manufacturing and processing magnets that are crucial to a lot of high tech and industrial components. And the US has pledged, if that happens, to remove some countermeasures that it's placed on specific sectors of Chinese industry. So there's still quite a bit of a way to go. We haven't seen the actual outcome of this yet. We haven't seen any necessary moves on the ground. And as you say, Danny, a much bigger global deadline for lots of countries coming in a week or so on July the 9th, when those reciprocal tariffs, as Trump calls them, would come in without any specific deals for other countries.
Well, to that point, Lutnick also talked about other trade deals being signed beyond China. Adam, what's our understanding and where the EU stands on this? An EU leader summit finished last night. I'm sure that was the talk of the town.
Yeah, we had Ursula von der Leyen, the European Commission president, coming out and saying what we've essentially understood has been the EU's position since the beginning, which is that they're prepared to hit back. They haven't, if the US does in fact impose what they would call punitive tariffs. The EU hasn't really revealed what it plans or could plan to do in this instant. They've tried to keep their cards a little close to their chest, while at the same time suggesting that they do have quite big weapons. Of course, they're a large trading bloc with the US, so feel they have quite a bit of leverage. But that one might well go down to the wire. There's clearly a lot to discuss between the EU with its 27 member countries and the US and Trump, and both parties have been. There has been some difficulty in getting those moving forward. Other deals that are being discussed, Trump was out saying that he was looking forward to perhaps what he called a very big trade deal with India. They've been trying to negotiate that. The Japanese have been making multiple rounds and visits and negotiation talks with the US. And there's been eyes, I think, on places like Vietnam as well, which has been in the focus. Lutnick said to us that he was expecting deals with perhaps 10 countries. So that might be one to keep track of as we head towards July the 9th.
Well, I guess, Adam, the thing to kind of evaluate, and you've been hinting at this, is it a framework? Is it a deal? What details still need to be hammered out to make it reality?
Quite a lot of them, I would say, is the answer. If you look back at the UK, which I think remains the only country to have signed one of these framework deals so far, the key was very much there. It was a framework. There was a lot of stuff still to be worked out, but they were able to do the basics and set out general principles, which meant that the extra levies that the US was planning to impose were reduced. So the UK would currently have that baseline of 10% reciprocal tariffs. They've sort of had to settle for that, and that we have to see whether that's what the US is willing to go to with other partners as well. But every country will have those specific industries which the US has targeted and said that it feels is unfair to US industry and exports. So individually, remember that before this Trump-era trade negotiations started, we were used to trade talks taking months, mostly years, and being really complex, line-by-line negotiations around export codes, categorization of goods, different types of processes and relations between states. This has all been put onto fast forward by the Trump administration. So it's not that surprising that detail is a little lacking sometimes.
Yeah, the last U.S. and China trade deal in Trump 1.0 took 18 months to hammer out. Now they just have over 10 days to figure out the rest of them. Adam, thank you so much. That is Bloomberg's Adam Blenford. Elsewhere in Washington, D.C., the Treasury Department has announced a deal with G7 allies that removes Section 899, or the so-called revenge tax, proposed from President Trump's tax bill. The provision was seen as a way to counter nations from taxing U.S. firms. Joining us now from Washington is Bloomberg's Kasia Klimanshinska. Kasia, I'm sure this is a relief to many.
Good morning. Yes. What a surprise. What a deal. U.S. Treasury Secretary Scott Bessent announced yesterday, unexpectedly, that there is a deal between the U.S. and other G7 countries where those countries will not tax U.S. corporations under certain OECD rules. That's a major win for the U.S. abroad, but also domestically, as you mentioned, there will be this one section 899, the so-called revenge tax, removed from the big tax and spending bill that is going through Congress right now. So that's again a win, some progress that makes passing this very big bill a little bit easier. It also means that there's one risk removed for those foreign investors, as that section, the revenge tax, the Section 899, would impose higher rates on some individuals and companies from other countries, from the EU, for example, from Canada, from Australia.
So maybe easier on that front to get the tax bill through Washington, D.C. But Kasia, where do divides still appear as Congress tries to get this thing done by the July 4th deadline?
Exactly. So it's a massive bill. It has a lot of Trump campaign promises, such as removing taxes on tips, removing taxes on overtime, and that has to be paid for, at least to some extent, to lower the increase in U.S. deficit. So Republicans were planning to pay for it in part by removing some healthcare spending, and that's where the problem now is, that an official in Senate parliamentarian said Republicans cannot do it without getting some support from Democrats. They cannot pass those taxes with a simple majority.
Kasia, thank you so much for that coverage. That is Bloomberg's Kasia Klimanshinska. Coming up, we're going to have a look at what's making headlines around the world, including a classified briefing on Iran that's leaving U.S. senators divided. We'll have the details for you in your Bloomberg Brief on this Friday morning.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Let's take a look at the front pages this morning. What's making headlines around the world? First up, the FT has this: more troubles for Tesla CEO Elon Musk. One of his top lieutenants and closest confidants has left Tesla amid plunging sales and a pivot to autonomous driving, AI, and robotics. Ahmed Ashraf has worked for Tesla since 2017. Sources say it wasn't clear if he will be reassigned to another part of Musk's empire. And in the Washington Post, a classified briefing on the impact of U.S. strikes on Iran's nuclear facilities has left senators split along party lines. Republicans said it reinforced their belief that the strikes were effective. Some Democrats complained that it didn't fully answer their questions. The White House has pushed back against leaked reports that the strikes only set back Iran's nuclear program in a matter of months rather than years. Of course, a very preliminary report. Coming up, trade optimism lifting stocks higher. We're near an all-time record. We're going to catch up with Keith Lerner of Truist, who joins me for the next half an hour. This is Bloomberg.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. Trade truce, the U.S. and China confirm a trade framework has been signed off in recent days. More deals. The Treasury Department works with G7 allies on removing the so-called revenge tax proposed by President Trump. And Nike leads sportswear stocks higher as it sees a clear path to recovery. 0.05%. That's how far away we closed from an all-time high yesterday in the market. Will we get there today? Futures seem to indicate so, up about 0.2%. For the NASDAQ, it's about 1/3 of 1%. It has been tech leading us higher. Today, we also snapped 7 days of gains for the Treasury market. We are looking at higher yields so far this morning, up 2 basis points for the front end. For your 10-year yield, it is almost 3 basis points over the past 7 days. 2-year yields have fallen 25 basis points. Let's get some stocks to watch this morning. Here with a look is Joe Easton. Hey, Joe.
Hey, Danny. So Nike shares now up around almost 10% in the pre-market trading. Better than expected outlook commentary was the main takeaway from the report last night. HSBC analysts upgrading the stock today, saying that the recovery is going to be a swoosh shape rather than a V shape. I wonder how long they were waiting to use that one, but I thought that was a nice little analogy. The stock gaining, as I say, on the outlook commentary. Rebounding. Air Force Ones doing well. Who doesn't love a pair of Air Force Ones for their trainers? We won't do the Nike Nike debate once again, but that stock is high today. Then moving over to Amazon in the Mag 7, getting an upgrade. BNP Paribas raising this one to outperform. The margins doing better. AWS, the Amazon Cloud Service, is the area that's going to beat analysts' expectations. According to BNP, they think that is the best stock in the Mag 7. Then moving over to Boeing, it's an upgrade for this one as well. It's over at Redburn, and the highest price target on the street, $275 per share. They think Boeing is worth. They do expect a bit of a reprieve following the recent issues at the company. Boeing shares heading up. We're up around 0.8% at the pre-market. Keep an eye on Boeing later today, Danny.
I'm sure everyone is relieved that we will spare them the linguistics debate. Joe, thank you very much. Joe Easton, thanks for your work all this week. Let's get back to our top story this morning. The U.S. signing a deal with China.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
China then confirmed the details of a trade framework while also reiterating that it will continue to review exports. Writing in a statement, it will, quote, review and approve eligible applications for export of controlled items in accordance with the law. Joining us now from Washington is Bloomberg's Kasia Klimanshinska. Kasia, the deadline ticking down, but it seems like something of an agreement has been reached with China.
Good morning, indeed. So another win, another surprise. Yesterday, President Trump, Commerce Secretary Howard Lutnick on Bloomberg TV announced that there is an agreement with China, and China confirmed that. So those talks in Geneva at first and then in London led to some sort of understanding that will unlock some additional trade between the two countries. But that's not the end of trade talks. President Trump is pretty much negotiating with the rest of the world. Remember, on April 2nd, he announced new higher tariffs on all U.S. major trading partners, for some as high as 50%. Those tariffs were then paused, but now we are heading towards July 9th when President Trump said some of those higher tariffs will return if countries don't strike trade deals with the U.S.
Where else are we on the development of those trade deals? Howard Lutnick also talking about 10 other nations possibly. Kasia, what could we hear and just how detailed will they really be?
Exactly. So Howard Lutnick mentioned 10 countries yesterday. President Trump mentioned India. So we are potentially looking at some sort of an agreement with maybe India, perhaps Japan, Vietnam. We also know that the EU is constantly talking to the U.S., but there is a lot of roadblocks there. So we don't have much time left, so probably they won't be comprehensive big trade deals. There will be just some sort of temporary agreements.
Kasia, thank you so much for your reporting this morning. Kasia Klimanshinska out of Washington, D.C. I'm so pleased to say that joining me now for the next half hour is Keith Lerner, co-CIO and Chief Market Strategist at Truth. Keith, great to see you this morning.
Great to be with you.
Well, the trade headline's the latest thing to help us get something close to an all-time high. Michael Hartnett over at Bank of America noting only 22 stocks are at all-time highs as the index is almost there. How much of an unloved rally, an all-time high is this?
I don't know that it's unloved, but it is somewhat narrow. But the reality, this bull market, the dominant theme has been AI. So it's not a coincidence that what's leading us higher is AI. And what we've seen already is the tech sector is already at an all-time high. So that, to us, that makes sense. But I will say there are some also other pockets doing well. The broker-dealer index yesterday made a fresh all-time high. Industrials are right close to an all-time high as well. You're seeing other areas like, staples and some of the defensive like healthcare, underperform energy, underperform after that bump. So, would I prefer to see more stocks participating, more stocks above the 200-day moving average? Yes. But that's really been the theme of this bull market is the tech side.
Yeah, but it was at the start of this year that part of the reason we said the U.S. started to underperform, besides the Washington, D.C. policy, was the narrowness of it. It was too concentrated. We need to go to Europe. Have we completely forgot about that narrative? Is that not the case anymore?
No, what's an interesting dynamic right now is that growth in the U.S. is working, but value overseas is working. So it's normally if you said, value and Europe historically have been in the same trade. Now we're seeing a divergence. I think part of that is the policy differential between the U.S. and the ECB, and more importantly, the currency is making that kind of divergence. And I think it's okay. That's what the market's given us. So from our perspective, we're overweight growth in the U.S. We're overweight tech communication services. Over this past couple of months, we've been increasing our exposure to developed international markets as well.
I know that you're still overall neutral, though, on U.S. equities, at least tactically. What makes you go either way?
Well, overall, on our stock bond cash allocation, we're neutral, but we still actually have a bias for U.S. equities. Now, what we've done is we've been underweight international developed for several years. We've moved that more towards a neutral state. So we're still Team USA, but on the margin, I think there's a lot of different scenarios that could play out. We're seeing the U.S. dollar break below this 3-year support level and having some hedge in the currency side, which you can do through overseas investing, I think makes a lot of sense. And again, there's some policy divergence. We're seeing more stimulus as well. So I think it makes sense to be somewhat less negative relative to the past few years.
The other dynamic in this, though, is with the latest leg higher in equity markets, you've also seen yields come down since their peak in about May. How much of this could you say is really down to just what rates are doing, to falling discount rates, and are vulnerable should we get some of that dovish language ebb at the Fed?
It's part of it. I would say that the biggest thing that for this rally that we're looking at is two things, actually. One is recession risk coming down, right? When the market bottomed, we had recession risk in the poly market putting in odds around 60%. That's down this morning to about 30%. And then the other thing with the rally, it's been moving tick for tick with that policy uncertainty index on Bloomberg that you've seen as policy uncertainty has come down, the market has moved up. Now, I will say that we've used a lot of energy. Like as that's come down, that's moved the market up. Today, I don't know that the poly market odds of recession are now stabilizing around 30. So yes, yields matter. What the Fed does matters. What inflation does matters. But I do think this. I think if we break above these highs, you'll get some forced buying in. But I also suspect that it may limit the upside because we've used so much energy just to get to where we are, at least on a short-term basis.
Well, it limits the upside, but as we've been talking about, the participation is low. So if you do get forced buying, how powerful is that this time around?
Well, I think to your point, maybe it broadens out more. What's interesting, going back to this breadth of conversation, you look at the equal weight S&P, and that's back at the lows on a relative basis to the S&P. So a lot of folks, were looking for broadening this year. We haven't seen it play out, and it's been somewhat weak. So we actually say, hey, the economy is still cool, and we're in the muddle through camp. We know this AI theme, that there's this secular demand that remains there. You are paying a premium valuation, but if that's the dominant theme, which when you look back at past cycles, that dominant theme tends to continue towards the end. We want to stick more with the growth side, even though we may have some rallies outside of that. And within that, we would say we would focus more on mid caps. That maybe as we see, more of this M&A activity pick up, that would be a beneficial.
Why not small caps?
Yeah, first of all, mid caps and small caps kind of move in tandem a bit. I would just say small caps are an interesting area because they are cheap. They've been cheap for a while. There's some structural changes in our view with small caps in that a lot of companies, the ones that go on IPO, they're coming out IPO at larger market caps because they're staying private for longer. The private capital markets are taking a lot of these companies, they're not coming to the market as much as well. So listen, if mid caps do well, you'll see a pop in small caps as well. I would just rather be a little bit higher quality, especially given the economic backdrop of we are seeing some cooling in the overall economy.
Keith, I'm pleased to say that you're sticking with us. Much more to discuss. That is Keith Lerner. Let's quickly, though, get you some other top stories that are trending on the terminal this morning. Iran has denied that nuclear talks with the U.S. are scheduled to resume next week. Iran's foreign minister says that no agreement nor arrangement has taken place to start new negotiations. At his news conference from the NATO summit last Wednesday, President Trump said that the U.S. will meet with Iran next week. And on the race for New York City mayor, sources say former New York Governor Andrew Cuomo has no plans of dropping out. That means his name will appear on the ballot in November as an independent. Cuomo lost to Queens lawmaker Zohran Mamdani in the first round of the Democratic primary. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to the Cuomo campaign. And the Treasury Department has announced a deal with G7 allies that will exclude U.S. companies from some taxes imposed by other countries. That's in exchange for killing the Section 899, or the so-called revenge tax, from President Trump's tax bill. Coming up, Nike extending gains in the pre-market as its turnaround plan finally seems to be paying off. We'll have more on that next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
You're watching Bloomberg Brief. I'm Danny Berger in New York alongside Keith Lerner of Truist. Now to earnings. Nike extending gains after jumping as much as 11% in the post-market following their earnings yesterday. Pre-market up nearly 10%. The sportswear company's fourth quarter revenue beat estimates, reversing earlier losses. Pitching a clear path to recovery, CEO Elliott Hill said, quote, "From here, we expect our business results to improve. It's time to turn the page." Joining us with the latest is Bloomberg's Katie Linzell. Katie, what did we hear from Nike?
So really, this looks like an improvement for Nike. CEO Elliott Hill is finally seeing some of his strategies start to pay off a bit for investors. They were able to say that on their guidance, it's really better than expected for analysts. It's still a sales decline, but it's better than expected for the current quarter. And I think going forwards, really, it's sort of been years and years in the making, but it looks like things could be looking up for Nike. Really, the performance has been better across the board. In China, still not quite where they'd want it to be. But yeah, finally, it looks like there's positive news here for Nike.
Hey, Katie, it's Keith. So regarding China, that was previously a big growth engine. We're seeing it down 20% as far as on the trends year over year. Who's making up the slack for China right now in their business?
I think we can look to sort of other parts of the globe for that. I mean, in the US, you've also got a weaker consumer there. For Nike, we have like a huge worldwide retail company. So really, they are able to look in other locations to pick up the slack. But yeah, in the US, you've also got some weakness. So it's not necessarily there.
Well, to that point, Katie, Nike, along with many other companies, are going to be feeling the stress of supply chains as they try to figure out even what the deal that was reached in more recent days with China and the US is. What is Nike doing to try to navigate those headwinds?
So Nike is going to be pulling back a bit, their reliance on China. And to say that, it's not like China is actually the largest exposure for them. But they have said that over time, they're going to be pulling back the amount of reliance they have on China. Vietnam is also another major geography for Nike that is maybe more important. And I understand that there are still talks ongoing to try and get a deal in place with Vietnam. So that's one that's going to be really important for Nike in the coming weeks and months.
Katie, going back to the U.S., mentioned the consumer's also weak here. Was there any optimism on the call that things are actually getting somewhat better, or is it just more of specific to Nike with the competition that they have, that they're kind of restructuring how they're doing things, or is there something on the consumer end that may be a little bit better or maybe a little bit worse?
I think it's going to need to be a case of time and see how this all pans out. Nike, like quite a few other US retailers, have said that they're going to have to be putting in place sort of surgical price increases. That's the language they used. We've seen Lululemon also say that they're going to be having to make price increases, maybe with them demand not being quite so strong to match those price increases. So it's really a case of seeing how the US consumer can cope with these increased prices and where things go from here. But for Nike overall, the tone is much more positive, and we've got to hope that we can see consumers stand by them in the months to come.
Katie, thank you so much for your excellent reporting this morning. That is Bloomberg's Katie Linzell. And Keith, it has been a moment where, as Katie was pointing to, you've heard a lot of American consumer companies talk about a value-driven consumer. What has been your read on the sector from what we've heard?
Well, I think it's very divergent, as mentioned. And I think the question even with Nike, as they try maybe a more premium strategy, will people pay up? But, you know, we are still seeing a divergence where people want discounts at one side of it, but they're also willing to pay for higher-end brands as well. So I expect that likely to continue. And the higher-end consumer still seems like they're kind of chugging along, you know, as a whole. I also think it's interesting just how these companies, including Nike, continue to adapt. I mean, even with you talk about supply chains, the currency uncertainty. I mean, that's one thing during this earnings season. We continue to, the last earnings season, that we just see this adaptability that continues.
Adaptability, but we're still not getting the full breadth of guidance we usually do. Nike, another one of the companies, General Mills, earlier in the week saying that we're not giving a full year outlook. As we're at all-time highs, is there a little bit of tension that we still don't have full visibility in what happens to these companies throughout the rest of the year?
Yeah, and it goes back to our earlier conversation. Why do we have somewhat of a narrow market as we break out to new highs? Because people are rotating to where there is secular growth, like technology, communications. And then we think about retail and the discretionary sector. It's such a diverse sector. You're just seeing a lot of more mixed trends. So in some way, I think it makes sense. Listen, we never have clarity exactly about the future. Now it appears even more uncertainty. But I do think there are some things, maybe as we look in the second half, maybe we will get some clarity in that tax bill, right? We're hoping for that. We are seeing some deregulation as well. And at some point, we still think the Fed likely starts to cut rates, maybe if that's 1 or 2. So I think on the margin, maybe we're getting past the worst of uncertainty, and maybe we start to get a little bit more clarity into the second half. And maybe that's what the market's banking on. But with valuations around 22 times earnings on a forward basis, the market is basically anticipating some positive news as we move forward.
Well, to that point, we are going to get more data today. Let's just look at the setup for the day. We're going to have more economic data, PCE, personal spending, income, and spending at 8:30 a.m. Eastern. That will be followed by UMich sentiment survey at 10 a.m. We're going to get some Fed speak. That wraps up the week with Williams, Hammock, and Cook on deck. And finally, the Fed's bank stress test released at 4:30 p.m. It's been a factor that the data has been uneven, especially with things like UMich, where the surveys don't necessarily match economic reality. Have we come almost benumbed to the new data that's coming in just because of the difficulty in understanding exactly where we are in this market regime?
That's right. I think, based on what your narrative is, you can paint a bullish story, a bearish story. And I think in the near term, because there's still questions, is the tariff impact going to start hitting the numbers more recently? I think the employment number next week will be very important. I mean, we are seeing in the labor market some cooling, but even there, mixed trends yesterday. Initial jobless claims down, continuing claims at a cycle high. So it's an economy that's cooling. We're expecting around 1.3% growth, but the inflation trends are coming down. We think that will allow the Fed to likely cut rates. And maybe some of those animal spirits that was all discussed late last year come back as we get a little bit of clarity later this year.
I'm sure the bankers would love that. Jefferies out yesterday with some pretty poor earnings because of the drop in M&A. What do you do with the sector right now?
Well, so we are neutral, the overall sector, but I say within the sector, there are some strong places, and I would say it's the bigger banks, but also the broker-dealer index, as mentioned earlier, just made an all-time high, and we also have some deregulation there as well. So what we're hearing from our capital markets, too, is that we did see the M&A side really close down, but we are starting to see more optimism out of that, and some deal flow starting again. So I think we're going to see a pickup in M&A. Remember, coming into this year, that's what the expectation was. That was pushed out. I think it's delayed and deferred, but I think we're going to start to see more of that in the second half. So I think it's actually a positive for the broker-dealers in general.
It is kind of crazy that it feels like it took all this time just to get back where we started in the year.
Well, I mean, that's the amazing thing. I mean, I went to one of our recent board meetings and I said, hey, market's flat for the year. Yields are back to where they started. Not much has happened. And also, as I look at the market as a whole, what I do on the S&P is I put kind of a piece of paper at that April decline. And the big picture is we've been 7 months in a trading range. And even tech, which just broke out yesterday, it basically traded sideways since last July. So almost a 1 year trading range. And one of the biggest stocks in there, NVIDIA, also had been trading sideways for that long. So the big picture is we've had a lot of movement, a lot of activity, a lot of news flow, but we really haven't gone too far. Now, the good news is at least we're starting to break above some of these ranges, which I think on a technical basis is a positive.
Keith, my takeaway is we should all go on vacation this summer.
It would have been very helpful to just, if we had the beginning point and the ending point, and just said we could have ignored it in the news.
Could have been the beach the whole time.
A lot less stress, a lot less gray hairs on my side.
Keith, thank you so much for joining this morning. It was such a pleasure to have you. This is Keith Lerner of Truist, and you are watching Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Wall Street pros often play poker, chess, blackjack, and other games that rely on skills that are highly transferable to their work. In the latest episode of Bullish, Bloomberg's Sonali Basak caught up with the Saba Capital founder, Boaz Weinstein, on the gambler's edge on Wall Street.
The reason blackjack is very similar to what I'm doing in closed-end funds is what I love about closed-end funds is I know the counts. There's the counts in blackjack, there's the discounts in closed-end funds. You know, we're sitting right now at flat count, actually. When there's a discount, the investor has an edge. And in blackjack, when there's big hurts to come, the player has an edge. And so we know what the edge is. In blackjack, we know what the odds are. In closed-end funds, there's uncertainty, but we know how cheap we're buying something. I think one of my talents is the ability to process tough times and see the bigger picture. And I think some of it may be connected to feeling lucky as a kid to have been born, you know, coming from a place where my mother, being born in the Warsaw Ghetto, her odds of surviving just simply being a Jewish person born in Poland, out of 3 million Jewish Poles, only 150,000 survived. So understanding that as a kid and feeling so lucky that I'm here, I think that also, plus the learning about loss by games, I think helped me be able to process losing in the markets and trying to keep a cool head.
Saba Capital's Boaz Weinstein with Bloomberg's Sonali Basak, and you can watch that full episode on Bloomberg.com. All right, that is it for your Bloomberg Brief this morning. Surveillance takes it from here on this Friday.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What moves the market is uncertainty. Tariffs are certainty at this point.
The marketplace has absorbed the idea of a 10% plus or minus tariff. The market has absorbed that and moved on.
The markets might overreact between now and September, October.
You're guessing what the center of the economy is. Overall, the consensus looks like to wait and see.
What we're looking at is probably a little bit more risk of a melt up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, just short of all-time highs. A mega-cap tech-driven rally helping to send stocks towards record highs as Treasury Secretary Scott Bessent pushes to strike down the so-called revenge tax, and Commerce Secretary Howard Lutnick primes the market for a bucket load of trade deals.
I think we have deal after deal after deal. The president's going to make his call, and then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements. We're going to set that all up and get that ready for July 9th.
And this equity market keeps grinding higher.
This year has been an exercise of tail risks being put on, tail risks being put off. And essentially, you said it best a while ago, John, when you said if you went to sleep on February 19th and you woke up right now, you basically would be in the same place that you were then. Things in the Middle East have calmed down. You're getting news of trade deals. It looks like the Congress members are bickering, but they're going to get some sort of deal done. Yields are lower, and the economy isn't cracking. Kumbaya, it's Friday, and that's the mood that we've got this morning.
There's a lot of hopium, isn't there?
There's
a lot of hopium going into July next week, for July 4th, for July 9th.
The timeline is so short right now, and the president even acknowledged that yesterday, saying I hope we get the bill by July 4th. That is 1 week from now to get this one big, beautiful bill through the Senate. It is still with the parliamentarian, who already is striking down some measures. It hasn't even gone through the entire provisions of it and the analysis of it. Then it needs to go back to the House, and they need to decide if they're going to fight with the Senate or swallow some of those changes. And then it's a week and a half to July 9th. So where are all these trade deals? There's a bucket load. Where, with who? Where are they? Are they going to have to extend the deadline out? And I think they are, based on some of officials on the other side of the table, negotiating with Ambassador Greer and Treasury Secretary Scott Bessent and Howard Lutnick, that they're probably going to have to give some of these countries a little bit more time.
This stock market has moved on, and moved on really, really quickly. This stock market on the quarter, a quarter that closes on Monday, the S&P 500 is higher by more than 9%. This is a quarter that includes April. Think about the fear and carnage after April 2nd for the next several weeks, and we've recovered from that and some in a pretty aggressive way.
So I was looking at data from DataTrack that showed that the NASDAQ 100 has seen the third fastest decline of 20% and then rebound of 20% to record highs in a really short period of time. It's been 85 days for this round trip. It just shows how sentiment's been driving everything. And I was thinking, I don't know if you know that advertisement, wax on, wax off, but it's sort of tail risk on.
Isn't that Karate Kid?
Tail risk off. Yeah, okay, then but it was also an advertisement for wax.
Back to the movie from back in the day.
Yeah, so it was like wax on, wax off.
I've got no idea where you're going with this.
Tail risks on, tail risks off.
And it's sort of like, is the threat of potentially the tail risk being taken off enough to allow this market to go substantially
Mr.
higher?
Miyagi, right?
Yes. Repetition,
Right? Yes.
trust.
I
mean, you can learn a lot from the Karate Kid. Yeah, we have to go there for today's market.
Let's go back to the all-time highs. So this from Michael Harnett of Bank of America this morning, really zooming in on the lack of participation here. This record high that we're very, very close to and will probably look for at the opening bell, only 22 S&P 500 stocks currently at record highs.
Yeah, what's old is great again, is new again, and that's really the big tech names that have been driving this, and it feels like that is going to be the leadership going forward. As so many people say, okay, now that we've worried about all of these things, we can now focus once again on the AI predominance that continues to drive earnings, both for tech companies and for the adopters.
We had some weight to the rally this morning. The Nasdaq 100 up another 1/3 of 1%, up a quarter on the S&P. Coming up this hour, Jim Bianco of Bianco Research with stocks near record highs. Tobin Marcus of Wolf Research with the US and China striking some kind of an agreement. And Neil Dutto of Random counting down to key inflation data and potential changes at the Federal Reserve. We begin this hour with stocks approaching record highs as investors quickly move on from trade worries. Jim Bianco of Bianco Research pushing back, writing on X the following: I share Powell's worry about tariff-driven inflation as the economy appears to be okay. I do not think the Fed should cut. Jim joins us now for more. Jim, welcome to the program, sir. What is the most convincing argument for you right now to lead you to believe that this tariff-driven inflation is just around a corner?
There's a number of services like Truflation and Price Stats that scrape data off the internet and aggregate like a daily CPI number. They're up 1% in the last 2 months. We didn't see the data show up in the May CPI report, but I suspect we're going to see goods inflation jump in the June CPI report and in the July CPI report as well. And so I think somewhere what they're showing us is prices are going up, and it's going to have to show up in that data.
And Jim, you know the pushback, the counter-argument to all of this. The labour market is not strong enough. You won't see second-round effects. Move on. Look through this. What's the counterpoint to the counterpoint?
Well, yeah, the labor market is moderating a little bit, but I don't think we're going to see enough of it to basically offset it. And what we're going to wind up with, look, what we're talking about now is about 2.5% inflation. And I'm suggesting, especially if you look at what's called the base effect, that last year's inflation number was 0, that you're probably going to move towards 3. And if you're going to move towards 3, that's going to be enough to keep the Fed on hold. That's going to be enough to say that fair value on the 10-year note is around 4.5%. So you'll get some moderation in that stuff, but that's why you're only going to move to 3, and you're not going to move to anything more significant than that.
Jim, it seems like the market is pricing in almost fully a rate cut in September. What happens to the long end if that happens? We've been asking this question repeatedly, and it's a real question that speaks to your belief, which is we're in a higher inflation environment. Do you feel that if they cut in the near term?
That's what happened last year. When they cut September of last year, the market, the long end rejected it because it went up over 100 basis points over the next 3 months. It all really comes down to how does the market view the environment and does it think a rate cut is appropriate? Now, the problem is we're seeing more and more that it seems like it's being political as far as whether or not the Fed should cut rates. You've got the parlor game getting played. Who's going to replace Powell? They're all coming out, whether it's Kevin Hassett or Chris Waller or Michelle Bowman, who are on supposedly the short list of who President Trump is considering to replace Powell, all trying to one-up each other by saying we need to cut faster and sooner. And it sounds more like it's a political thing to kind of get into the graces of President Trump than it is to make economic arguments. If it is political, then you could see a repeat of last year. You cut rates or threaten to cut rates, and you'll produce higher long-term rates. If the market is in sync with that belief because the economics dictate it, then long rates will fall with the Fed cutting rates.
Well, it seems like right now an increasing number of Fed officials are looking to the July 9th deadline to understand exactly what the tariff rates are going to be. How relevant is that, considering the fact that you think that there is this sort of underlying inflationary environment at really any tariff level above 10%? I mean, does it matter if it's a lot lower than people previously expected?
Well, yeah, that and also non-tariff barriers and how they're going to work those out and whether or not they're going to bring down enough of those that even if the tariff rate is above 10%, that the all-in cost kind of gets moderated. But you're right. I think that, if the July meeting is in play, there's 3 events that are going to come real fast. A week from today is going to be the payroll report. July 9th with tariffs, as you mentioned, and July 15th with CPI. If any of that data is perceived as being weak or maybe, less inflationary than I think you're going to see, again, going back to the political Fed, a scream that we got to cut rates right now, and we could put that July meeting into play in the next couple of days.
Jim, yesterday the president once again criticized Jay Powell. He said we have to get rid of this guy. He's not doing the job. Who do you think would be, after those list of names that you and I both know about out there in the press, would actually be seen as credible to the market?
Well, other than the president himself, I guess that it would be Chris Waller, current Fed governor, Kevin Warsh, who is a former Fed governor, seemed to be topping the list, as well as Kevin Hassett as well. So those are probably the big three names, with Scott Bessent in there, although I think he's more of a long shot, and David Malpass of the World Bank. Those are the names that are being thrown around.
But
I
Waller
think
and Warsh, Waller
Yes.
and Warsh are currently not working for the administration. Someone like Kevin Hassett works for the administration and goes on a lot of television networks constantly and just touts whatever the president wants. Does he actually seem like a credible voice?
Well, he is a credible voice in that, or he's a credible candidate, I should say, because of his background and his training. So he would be a credible candidate. But I would also say that there's another issue too, that if he were to pick, the president were to pick somebody like Michelle Bowman or was to pick Chris Waller, who are currently on the Fed, I think he's basically picking them to basically say, burn the thing down right now before you even become the Fed. I want the rate cuts in July. I want the rate cuts in September. If you have to hold the FOMC hostage right now to get it done, that's going to be the Hobsonian bargain that they're going to have if they're already on the Fed. If you pick somebody who's off the Fed, all they can do is go on TV and scream for it. They're not actually in the room and could actually twist arms to make it happen. So this is why I fear that we're about to, or at risk of leaving the realm of economics and entering the realm of politics when it comes to what the Fed's going to do for the second half of the year.
What do you think the consequences are of that, Jim?
If the Fed is going to be political, meaning that they're going to do something that is not in sync with the economics, it is in sync with the politics of what the president wants, then I think you could see long-term interest rates, especially like in the 10-year note, shoot right through 5%. It won't like it. It'll say you're stimulating when we don't need stimulation. You're going to create more inflation. You're going to create maybe a bubble because you're going to make money cheaper when we already are at an all-time high, and it's not necessary to fan those flames even more, if that's the way the market views it. Now, if the data does slow down enough to support those rate cuts, it won't do that. But that's really what political means, is that we're going to ignore the data and we're just going to do what we want to do. And the president seems to be arguing it that way too. His argument is we want to lower interest costs. Okay, I want to lower my interest costs too. I want my mortgage rate to go down, but that doesn't, I don't wish it down. I need to have a better credit rating to get my mortgage rate down. We need to have the economic data justify lower interest rates, not that we wish to pay less than interest costs, which seems to be their main argument.
If they go too soon, you might see actual mortgage rates go higher. And that could be another problem. Jim, thank you, sir. Jim Bianco there of Bianco Research. This could be dramatic. It might not be. We explored this on this program yesterday. By the time you get to September, there might not be that much daylight between what the administration wants and what the Federal Reserve is doing.
I keep thinking about what Jim Zelter said. This is the perfect fall guy for President Trump. Why would he eliminate an ultimate fall guy where there are no apparent consequences for him to keep jawboning him? Yesterday he was saying something like, if you lower the interest rate by 2 points, by 2 percentage points, you end up with $600 billion of savings in terms of interest expenses a year. I mean, he's calculating it out and trying to figure out where to get savings. He's like, here's a place. I don't know how seriously you can take it.
He's looking at the same charts we are, and he's a debt guy, and he's saying we're paying so much more for the interest of our debt. It's surpassed our defense budget. So the president, in that sense, is looking at where he's trying to save money. He has a point. The fact of the matter is, to Jim Zelter's point, this is the perfect fall guy right now. He took another shot at him yesterday. If he's not there, then that's going to be a little bit more complicated.
We've talked a lot about how this equity market has recovered, and some, do you know what hasn't? The dollar. DXY so far this quarter is down something like 7%. I think it's the worst quarter going back to 2022.
And a lot of people are painting this now as sort of a fundamental economic picture. How many people have come on the show and said the one person making bank at every single financial institution is the FX derivatives trader? And that is the person who's going to come out ahead of everything of 2025, because suddenly, in foreign investors still investing in the U.S., but they're hedging their risk.
I think it was Jim that was talking about that yesterday.
Jim was talking about it, yeah, other people as well.
Deutsche Bank's going to join us later. They've got a similar thing to say too. Jim was talking about payrolls. Just a programming note. It's next Thursday, not next Friday. July 4th holiday here in the United States. The estimates so far, just a sneak peek of things as they come together. The estimate in our survey at the moment, 120. The previous number, 139. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, let's cross over to Yahara Arnott for more. Hey, Yahara.
Good morning, John. A trade deal between the U.S. and China was apparently signed 2 days ago. That's according to Commerce Secretary Howard Lutnick. In an interview with us, he said the deal codifies the terms laid out in earlier talks, including China's commitment to deliver rare earth minerals. China confirmed the framework of the trade deal this morning. Meanwhile, Iran is denying it's holding nuclear talks with the U.S. next week. President Trump had said a few days ago there would be negotiations, but Iran's foreign minister told state television that speculation about new discussions should not be taken seriously. He said damage from the U.S. attack on the country's nuclear facilities was considerable and serious. And a check on Nike shares. They are rising 9.3% in the pre-market after signaling its sales slump has hit a bottom. CEO Elliott Hill saying on the call there is a clear path to recovery ahead of us. Sales are still expected to dip this current quarter, but by less than expected. Nike is also taking steps to offset about $1 billion in tariff costs by raising prices and cutting back on manufacturing in China. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, priming the market for a bucket load of trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. I think we could get a deal done now. Europe will be right at the end.
What's in store for Europe? We'll get the view from Europe in just a moment. Plus, we'll catch up with Tobin Marcus of Wolfe Research. We'll do that next. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
At the close on Thursday, just 0.05% from all-time highs on the S&P 500. That close looking to breach that later on this morning. Equity futures positive by 0.2% on the Nasdaq 100, up by 0.3. A lot of hope out there under surveillance this morning, priming the market for a bucket load of trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. That deal was signed and sealed 2 days ago. I think we could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partner, so the fact that they come at the very end makes some sense.
Here's the latest this morning. The US and China confirming they've finalized the trade framework reached in Geneva. The Commerce Secretary, Howard Lutnick, adding the White House has imminent plans to reach agreements with 10 major trading partners. Joining us now from Europe, Bloomberg's Ollie Crook. Ollie, you heard it there from the Commerce Secretary. Europe will be at the very end. What are the Europeans planning to do?
Yeah, absolutely, John. And we had all the European leaders that really fresh off of that NATO meeting. Their next stop was in Brussels, where they met yesterday. And that's where they're sort of beginning to have this conversation. I say continuing to have this conversation. And the conversation around the table for European leaders is basically how much pain are you willing to take from the United States? How imbalanced a trade deal are you willing to accept from the United States? And what we're hearing from a number of different leaders is a little bit more pragmatism. Originally, we heard from Emmanuel Macron. He was still aiming for that 0-for-0 deal. We heard from his commissioner here in Europe saying that basically even that 10% barrier would prompt retaliation from the EU. We're getting some pushback on that narrative. We heard from the German Chancellor, Friedrich Merz. This was his first leaders meeting yesterday. I'll quote directly what he said. He said, "It's better to go fast and simple than slow and highly complicated. We need to reach a deal very quickly," and we've all agreed to that. There is no disagreement there at all. We've heard similar things from the likes of Giorgia Meloni. So right now for European leaders, though they feel that what the U.S. demands have been, and we don't know what those demands are in great detail, are asymmetrical, are unbalanced, are unfair, they're willing to compromise, it seems, to get a deal done pretty fast. That being said, I think it's very unlikely that we get that full deal by the July 9th deadline. Hopefully, I think what they're trying to get right now is to get sort of a broader framework in place so they have a little bit more time to negotiate. I wouldn't be surprised if Ursula von der Leyen has to get on a plane in the next couple of days to go to Washington, D.C.
Ollie Crook, they might be very busy for the next few weeks. Appreciate the update. Oliver Crook there out of Brussels this morning. I think from the White House side of things, there is just this belief that to rebalance the trade with any nation, with any trading bloc, the agreement needs to be imbalanced in order to rebalance. And how much of an imbalance you're willing to accept on the other side of the deal seems to be a bit of a sticking point.
Interesting, though, what Oliver's saying. This sounds actually even very different than what I heard earlier in the week when I was in the Netherlands, that they were going to have this tremendous amount of pushback in the European Union. Maybe they realize, actually, that tactic is not going to work, especially if we want an agreement by July 9th.
That's Europe. Let's talk about China. Tobin Marcus of Wolf Research joins us now for more. Tobin, welcome to the program. I just want to pick up on the language, the words used by the Commerce Secretary, Howard Lutnick. We inked the deal. What's the deal? Do you have any details whatsoever?
This seems to be the third time that they've inked this particular deal, because it seems to be a solidification of the framework to get back to the Geneva consensus that was reached about 2 months ago. So it's good to have that locked down, but it does not really look to me like that's delivering any kind of incremental relief or incremental steps forward. It's just solidifying the sort of set of understandings that was required to keep the trading relationship from going further off track in terms of access to rare earths on their side and the rollback of some of the incremental export controls on our side.
I was at those talks in London, and I still can't get from this administration an idea of what the language looks like, who signed it. The Chinese say earlier this morning, the U.S. side will correspondingly cancel a series of restrictive measures taken against China. Which measures?
So it seems, from my perspective, that the Chinese have been primarily focused on the further expansion of export controls that took place after the Geneva meeting. So certainly the restrictions on natural gas liquids, on aerospace, on EDA software, those I think are clearly in the set of things that are going to be rolled off. The initial vote of contention from the Chinese side was this declaration that anyone using Huawei send chips is in violation of U.S. export controls, that the U.S. side characterized as a restatement of existing policy and the Chinese side characterized as incremental expansion of export controls. So that, in my mind, is the question. I don't think that the U.S. Has committed to rolling that back, but that, I think, is sort of the final piece of wiggle room in how we understand this.
This isn't a trade deal. This is just an understanding of some of the de-escalation we've seen in these talks in Geneva and London. So where does this leave the relationship more long-term for more of a comprehensive agreement?
It still looks very challenging to me. I think that the bullish narrative in markets immediately after the Geneva meeting was we've come down to 30, but of that 30, 20% is fentanyl related, and that should be an easy thing for the Chinese side to alleviate Trump's concern on. This is an authoritarian society. Well, like, we should just think that they can flip a switch and do whatever they need to do on export controls on fentanyl precursors to satisfy the U.S. side. I think that's easier said than done, even to the extent that they can fully allay our substantive concerns. There have been multiple rounds of headlines from Bloomberg, among others, about Vietnam aiming towards a 20 to 25% tariff rate in their talks. Even if we reach a deal, that's what the deal would consist of. And if we're taking Vietnam to 25, it does not really make sense to take off that 20% fentanyl tariff and leave China at 10. It would be very upside down to go after Vietnam, where the main concerns have been around them as sort of an outlet for Chinese industrial overcapacity and transshipping and so forth, and hit them harder than China itself. So I think we have a long way to go. The Chinese love slow deliberative mechanisms, and that's what we have in place now. And I think these talks will drag out for quite a while longer before we get further incremental easing.
Isn't that, Tobin, kind of what we expect across the board, that this is going to be a process and there are going to be frameworks that are going to be announced on July 9th that will then kick the can down the road? And right now the market is banking on escalate to de-escalate, as John was talking about when it came to Iran, but also when it comes to trade deals and what the path forward is likely to be for the president.
Yeah, so I think I am less optimistic about exactly what these deals are going to deliver in terms of market relevant relief than I think sort of hullabaloo about deals in general and deal making as an enterprise would suggest. Lutnick's indication that there's going to be 10 of these deals announced, we'll see. They've been teasing a bunch of deals right around the corner for about 2 months now. But even if deals get rolled out, again, Vietnam being, in my mind, sort of the easiest or most important example, we seem to be aiming towards a significant increase in reciprocal tariff rates in that set of talks. So if we roll out that deal, that's not like good news for the market. It's not good news for Nike, to take one name that was mentioned just a moment ago. And similarly elsewhere, like the sectoral tariffs have been the sticking point primarily with Japan, with India to some extent. They will be a huge sticking point with the EU, although those talks are not quite as far along. It doesn't really look to me like the U.S. side is going to give on those. And so if we get a bunch of deals that don't drop the sectoral tariffs, I don't really think that this represents a big kind of dovish impulse for markets.
Tobin, appreciate your time and your opinion. Thank you, sir. Tobin Marcus there of Wolf Research. We can debate whether things are good. Ultimately, they're better across 3 different dimensions. On trade, they're better now. Things are better now than they were on April 2nd, that's for sure. On taxes, they're better now than they were about a month ago. And on geopolitics, they're certainly better now than it was just last week.
Yeah, tail risks on, tail risks off. That really has been sort of what we have seen. I will say, if you take a look at the data, the economic read-through, Toyota, for example, raising prices of cars in the U.S., China's industrial firms taking a hit on margins from some of the tariffs, it's being borne out in a lot of different places.
That's the ongoing argument.
Yeah.
Who's going to take the tariff hit? And we'll explore that argument through the next hour or so, and the next several months, and the next several years, and maybe beyond. Coming up on this program, Tim Baker of Deutsche Bank with the US dollar at 3-year lows, plus Danny Berger with your morning movers, with Nike jumping in the pre-market by 9%.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Coming into Friday, 0.05%, away from all-time highs on the S&P 500. Equity futures here positive by another 0.2%. Striking distance of all-time highs on the S&P. On the Nasdaq 100 up by 0.3. In the bond market, two-year bond yields in focus at the front end of the yield curve. Coming into Friday, for 5 consecutive sessions, yields lower through Thursday. Down about 16 basis points on the week now. Retracing some of that move, we're up by 2 or 3 basis points. More on Fed interest rates later on in the program. I want to finish on foreign exchange, switch at the board and get to the euro. The euro having a look at a 7th consecutive day of euro strength against dollar weakness. Euro dollar is through 117. We'll get back to the FX market in just a moment. Let's take the opportunity to get you some morning movers. Let's do that with Danny Berger, who has more. Good morning, Danny.
Good morning, John. Leading tech higher this morning, leading the Mag 7 higher, or at least overall stocks higher this morning, I should say. I'll get to tech in a moment. Nike outperforming. It is up 9.1%. The hope is that because they forecast the current quarter to be better than expected, that the bottom is in for this company, that things are starting to turn around. It's been a series of steps the CEO has put into place, trying to help with stock, trying to focus on athletics, though they did not give an outlook for the full year given tariffs. You're also seeing other athletic companies rebound off of this too. Adidas in Europe, here in the US, Lululemon also doing better off the back of the outperformance in Nike. Those shares up more than 1% this morning, maybe giving hope it's not just a Nike story, but consumers are buying and it can be, you can become cool again. Finally, we'll wrap it up with Amazon getting an upgrade from Xane this morning. That's the one that's leading Mag 7 higher. It is up almost 1%. Xane saying that among the hyperscalers, that Nike is the most poised to outperform, that eventually through 2030, they're going to start to be hit by depreciation costs. But Amazon looks more attractive when it comes to controlling their margins, John.
Danny, thank you. More from Danny in the next hour. Tech leadership has been absolutely stunning. JP Morgan and the team in the investment bank out with their mid-year outlook. The growth slowdown and higher for longer rates are likely to lead to a repeat of the 23-24 playbook of narrow leadership and high market concentration. It's been a theme.
Yeah, and one thing that people have pointed to is that valuations look elevated, except that they don't suddenly, because profits have been so big at these tech companies that their valuations are actually coming down even as their stock prices go up. So it just shows the conundrum of trying to bet against the behemoths of the United States.
Nasdaq futures up another 0.3%. On a radar this morning, the US and China signing a trade truce after finalizing an understanding last month in Geneva. The White House saying it has imminent plans to reach agreements with 10 other trading partners. Big question, who's the 10?
Who's the 10? Potentially India. The president mentioned them yesterday, and they've been out front in terms of this negotiation. Remember, Prime Minister Modi, first leader basically to come here after the inauguration for a meeting. Maybe Japan, the European Union, we know that would be a little bit more complicated. I'm still stuck on what's going on with China. What did they sign and who signed it? They signed basically an agreement based off the Geneva and London discussions, but what's in the details? We know rare earths is potentially, but how much did the U.S. go in terms of rolling back some of those export controls? And is that going to implicate national security concerns?
Yeah, just to build on that. I mean, John, what you say is the big question is, who are those 10 partners? The big question is also, what did the U.S. give up? Also, the question is, what are the countermeasures? Also, the question is,
a big question.
I mean, there are a lot of kind of vague aspects of this, and I think that that's the real question. Why is the market feeling like this is a real positive development? Because right now there is a feeling of a wish to de-escalate, and so even if this is kicking the can down the road, this means that probably there isn't going to be a re-escalation that could reintroduce a tail risk to markets.
And to your point, Lisa, not just on trade, not just on geopolitics, also on taxes. Republicans dropping the so-called revenge tax from the big, beautiful bill after the Treasury Secretary, Scott Bessent, announced a deal with G7 allies that will exclude U.S. companies from some taxes imposed by other countries.
So Wall Street is definitely going to be breathing a sigh of relief from this, especially global Wall Street. There was this fear that it would make forcing individuals, basically, and companies to not want to invest in the United States. It just goes to show that potentially this whole revenge tax was basically just used for them to go into and negotiate as leverage, and they weren't ever really going to put it in the one big beautiful bill.
Lisa said it. We were talking about escalating to de-escalate. We're de-escalating going into July. That's why we are very close to all-time highs.
It feels like the adult in the room says, cut it out, guys. This is idiotic. And that's kind of what it sounds like is happening.
Who's the adult? Scotty B?
That's Scotty B.
That's what a lot of people think, right?
Yes. And he's the one that announced it yesterday. Actually, his deputy also hinted at the negotiations on balance of power 2 evenings ago. So we got a hint that potentially this was in the works. And the Senate came out, Senator Crapo came out and said, yeah, we're getting it out of the one big beautiful bill. But remember, the House voted on it. So the House has to deal with all of these edits and either swallow them or put up a fight. And I think you're going to see a fight.
The Treasury Secretary, we should say, and not Scotty B. That's the president's
What's what the president calls him?
Yeah,
we can't call
the president can call him whatever he wants, but I think we should stick with Treasury Secretary Scott Bessent.
Maybe he'll have like a hat.
Or you could say
Scotty
Treasury Secretary Scotty B.
Scotty B. We'll ask Scott himself. Let's turn to this story. Andrew Cuomo is staying in the New York City mayor's race. Sources telling us here at Bloomberg his name will appear on the ballot in November as an independent after a stunning defeat in the Democratic primary to the Democratic socialist Zohran Mamdani.
This is the race to avoid a spoiler. How do you coalesce all of the anti-Mamdani votes around one candidate? And yes, all of a sudden people are saying, corruption charges, is that so bad? Sexual harassment charges, is that so bad? Which one are we going to really fall behind? Because ultimately, if you do have a tax on the wealthiest individuals, and you do have some of the policies that Mamdani put out there, people are talking about an exodus from from New York City. So this really is going to be a battle. How do you coalesce all of the other votes around a candidate who's not running on the ticket that normally wins the mayoral race in New York City?
Also, there's this concern that Cuomo is not going to run a very active campaign. And then you have the likes of Eric Adams in the race now. And if your whole goal is to basically say, we do not want Zohran Mamdani to win this race, then you have to get rid of one of those alternatives and go behind one person. But Cuomo says that he's staying on the ticket, so to your point, it might be a spoiler.
It's a battle, and the victim is the city, and that's the problem. And I think it's important to frame who the battle is between the Democratic establishment and the extreme fringes of the Democratic Party. It's their argument. It's their argument also on the national stage. It just happens to be playing out here in New York City, and that's unfortunate for this city.
You know, John Lieber put it well. This is not a welcome development for the Democratic establishment, because right now there is a real battle, and it is not between Democrats and Republicans. It's between the different fringes in both parties versus a more centrist traditional party that is trying to figure out how to move forward, and this is a battle that's going to play out over a lot of years.
This is the center of not just the United States, but the world in terms of capitalism and business. He was asked last night, Zohran Mamdani, on CNN, do you like capitalism? Quote, no, I have many critiques of capitalism. There must be a better distribution of wealth in this country. That is not going to fly with the majority of people living in this city.
A lot of coverage on this story still to come. Let's turn back to the markets. The dollar falling to a 3-year low on renewed bets of a Fed rate cut this year. Tim Baker of Deutsche Bank writing, the calming of geopolitical risk removes a driver of dollar strength. Tim joins us now for more. Tim, welcome to the program. You've written lots recently about selling versus hedging dollar exposure. Could you walk us through that? Just help us understand what's happening here, because it sounds like from your perspective, people aren't selling dollar exposure, they're hedging it. What's the difference, Tim?
Yeah, the difference is over the last few years, you've had global pension fund managers, life insurance companies, sovereign wealth funds invest heavily in US assets. That was the place to be. That's where you got a stack of safe assets in the form of treasuries. Perhaps more importantly, you've had the best performing equity market in the world. So it made sense to accumulate dollar exposure these last few years. Hedging it to remove that currency risk. That it wasn't done quite as much. It's been very expensive to hedge the dollar over the last few years. And hey, what's the point in hedging against it? It's doing well. So we come into this year and we do a deep dive on the numbers. December quarter, March quarter. Globally, these pension funds, lifers have been very light on their hedge ratios because of that. There's just a lot of unhedged US dollar exposure, and that runs headlong into the German fiscal shock, a shift in correlations between the dollar and equities, the dollar and yields, and then we get Liberation Day and all this US policy uncertainty. So these foreign asset managers are kind of thinking, hey, hang on, I thought I'd be okay with exposure to the dollar. It's hurting me a little bit. Maybe we need to revisit that. Now, they can do that relatively quickly. I don't think they've done it entirely yet. I think there's still more to go. I mean, probably Asia, Taiwan specifically, has done quite a bit already, but I think that's still a story in train. As far as actually moving away from US assets, that's a bigger decision. These kind of staid and steady pension fund, life insurance companies, they have quarterly investment committee meetings. Let's think it all through. I think that lies ahead. What's most interesting there is that Canada sold a ton of US assets in April. No one else did really, but Canada did. Why is that interesting? Because Canada was one of the first affected countries by Trump's tariff threats. This is like February, March, there were threats. So, after a couple of months, maybe Canada took the view, we want to pull back some of our very heavily overweight US exposure. If that's kind of the canary in the coal mine, we might expect more selling of dollar assets as the year progresses, as a delayed response to US policy uncertainty. So I think both of these are very important, the hedging and the allocation story, because it kind of marks a big turn in the dollar. And yes, the dollar's fallen a lot already, but if we're talking about a big, once in a decade kind of shift away from US dollar exposure, whether it's lifting hedge ratios or selling US assets, there's plenty more in this dollar down cycle to go.
There's so much to unpack there, Tim. This whole tail risk on, tail risk off. There's been a belief that where this is the end of U.S. exceptionalism, and it's really evidenced by the decline, the weakening in the dollar. The idea of it just being simply hedging risk after more than a decade of being benefited by both the strengthening in the dollar and the rise in U.S. equities is a lot more of a sanguine picture. If it were just that, if it was just increasing the hedges, how much more weakening would there be to go?
Yeah, it's the coalescing of a lot of things, right? It's not only that, but, the dollar is historically expensive. The current account deficit has been widening. The fiscal deficit is large and, look, it's not shrinking, right? Probably widening. So all these things come together. So I guess I just make the point that, earlier in the year, you could say, hey, German positive fiscal shock, US negative shocks around tariffs, and the euro-dollar move you might have expected on the back of that. Maybe that's all been and gone, but these bigger vulnerabilities and this positioning overhang and this large unhedged position, all of this stuff's coalescing. I think that initial kind of response, just from kind of fast money, how we respond to the news flow through February, March, and April, that's probably done. And when I look across positioning indicators, dollar shorts aren't what they were, but I think it's kind of carrying you're handing the baton over to pension funds, to lifers on the hedging, and the reallocation story lies ahead. So I guess it's kind of multi-stage. I mean, how far does it go? When the dollar's really rolled over after past peaks, you're looking at 20% at least down in a year, more like 25% plus. We're not quite that bearish. We've got euro-dollar for 120 end of the year, for example, dollar-yen for 135. It gets some support from still being a high yielder. Now, that's taking a little bit of a knock this week with some of these dovish Fed speakers, but another 10-15% down over the next year is certainly possible. This is a big shift, and the dollar tends to trend. And so there's volatility, the week-to-week news, I guess, around that structural downtrend we still see in place.
Hey, Tim, smart stuff as always. Thanks for the update. Tim Baker there of Deutsche Bank, looking for 120 on euro-dollar. We might get there in a few weeks. 117 right now.
Yeah, I was also curious about what he said about Canada. I wonder how specific the anger from Canada actually is about selling the assets versus other places, because you did see huge Canadian outflows from the U.S. You've also seen tourism fall off a cliff. They're just bypassing the U.S., but tourism from other places has changed. So it's a particular wound and resentment for being sort of deceived.
They're pretty bitter about things, that's for sure.
And they're so kind. But, I understand.
It's kind bitterness. or bitter kindness?
Well, it's the kindness that's been thwarted that is resentment that is very difficult to
Shouldn't
eliminate.
laugh about it. It's a serious issue, I know that. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. President Trump says that a trade deal could be signed soon with India that would open up the Indian market to American business. Negotiators are set to meet in Washington to break a recent deadlock over key issues. Trump's reciprocal tariffs are set to take effect on July 9th, and an early deal would help India avert the hike. Meanwhile, the Bank of England is considering softening new trading book capital rules to push ahead with global banking reforms by 2027. This aims to keep UK banks competitive with Wall Street, especially since the UK's approach won't raise capital demands, which are in the EU and US's plans. An update from the central bank is anticipated this summer. And Xiaomi shares touched a record high after initial orders for its new $35,000 SUV came in very strong. The company says that within an hour of launching, it got over 289,000 pre-orders for its U7. The new model will be a key test of demand for Xiaomi cars after a fatal crash involving a different model sparked scrutiny from Chinese authorities. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes from now. Up next on the program, a full rate cut.
One of the challenges of central banking that you just have to accept is that we never have perfect data. We can't wait for perfect information or we'll be behind, and we can't do that to the American people. The fall looks promising for a rate cut.
Neil Dutta of Renmac thinks it might come sooner than that. He joins us next on the program. Live from New York, you're watching Bloomberg TV.
In case you missed it on Bloomberg Insight. I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting this. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
on the week so far on the S&P 500 through yesterday, higher by close to 3% on the S&P. It would be the biggest weekly gain going back to mid-May. Equity futures added some weight to the rally, up another 0.25% on the S&P 500, on the Nasdaq 100 by 0.3%. Under surveillance this morning, a full rate cut.
You have to make a view, you have to have a view about what you think tariffs will do to inflation. Now, my own view is that they will potentially raise inflation, but they should dissipate. One of the challenges of central banking that you just have to accept is that we never have perfect data. We can't wait for perfect information or we'll be behind, and we can't do that to the American people. The fall looks promising for a rate cut.
Here's the latest this morning. Investors boosting Fed rate cut bets for this year as President Donald Trump talks about naming a replacement for Fed Chair Jay Powell. Neil Dutter of Renmax saying, quote, what Trump needs are people that can intellectually defend arguments for dovish monetary policy. Chris Waller is that person. Joining us now is Neil Dutter of Renmax. Neil, welcome to the program, sir. If Waller is the right guy, who's the wrong person and why?
Well, I mean, I think it's pretty clear who I think the wrong person is. I've said it. I thought he was the wrong pick for Treasury Secretary, and I think he's the wrong pick for the Fed. Yet President Trump continues to play footsie with him perpetually throughout his political career, and that's Kevin Warsh. You know, I mean, I've been on record as saying Waller is the guy. I think he's an out-of-the-box thinker. You know, he's already there at the Fed, so you want to talk about a shadow Fed chair. I mean, he was on the financial media not too long ago advocating for a July rate cut. So, you know, he's already making the arguments within the FOMC as it is, and he's going out and kind of litigating them in the public. So, you know, that shadow Fed chair idea, we already have one, and his name is Chris Waller.
How economically defensible, Neil, do you think his argument is?
Well, I think his argument makes a lot of sense. I mean, if you look at, I mean, basically it's a labor market driven view, right? You know, they've said for the longest time that the labor markets are no longer a source of inflationary pressure. What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow. We see that now it feels like week after week after week with extended unemployment claims rising. And that's primarily been so far because the hiring rate has come down. But typically in an economic cycle, hiring tends to turn first before layoffs turn up. And so that, to me, is the concern. And if that happens, you'll get a much more rapid increase in extended unemployment claims and unemployment more generally from here.
Neil, you've been harping on the idea that there really should be rate cuts, and that this should be a much more dovish Fed, and that there really is no reason for them not to cut. Right now, we have 2 to 3 rate cuts getting priced into the market, with September being almost a lock. Is that enough for you? I mean, isn't that basically the same thing that you're saying? Where's the daylight here?
Well, I mean, you know, these things tend to move in waves. I mean, it's sort of slowly, then all at first. I mean, I do think the markets, I think, are still looking for a smoking gun. And, you know, to me, that could be a negative payroll print at some point over the next few months. And when that happens, I think the markets will begin to price in more rate cuts between now and the end of 2026.
I guess that's really the question, Neil. It seems like over the past couple of weeks, people have moved away from this rubric of a smoking gun or some sort of break in the labor market to we're seeing disinflation. We may see ongoing disinflation today with core PCE when we get that out in a little less than 2 hours' time. And the Fed, if it's coming without any kind of sense of, you know, real acceleration in the labor market, will give them the right to cut. I mean, isn't it sort of the Fed's moving in the direction that you want it to go in? I mean, do you really disagree or take issue with what they're doing right now, given that the rhetoric is coalescing around September and possibly another rate cut this year?
Well, I mean, I guess the question is, are we in a situation where the labor markets are slowing in such a way that it's getting away from them, that creates, you know, a more of a need to step out in front? I mean, that to me is what I'm worried about. It's encouraging that they're moving in the right direction, but you know, going 2 or 3 times this year and a couple of times next year, which is sort of, I think, where the market's at, I don't really think that's going to get the job done for the U.S. housing market. And so, you know, if the housing market's not really providing a tailwind for growth, And it's possible that you start to see some slowing from the AI CapEx euphoria that we've seen this year. I mean, remember, that's turned into a macro issue, right? I mean, you've had a massive CapEx boom because of AI and tech. If that starts to recede, you're talking about additional downside risk to 2026 that people haven't really talked about yet.
Neil, if we could just get back to the Fed race. You were very supportive of the Treasury Secretary, Scott Bessent, to be the Treasury Secretary. Why not Fed Chair Bessent?
Well, Anne-Marie, who was the first Treasury Secretary of the United States?
Charles Hamlin. Treasury Secretary was Alexander Hamilton. The Fed Chair was Charles Hamlin.
Well, you must have looked on Wikipedia, because most people, I mean, they're writing.
Because I knew this is your thing.
They're doing musicals about the Treasury Secretary, Anne-Marie. Call me when they do one about the Fed Chair. And
so you think he wants a musical after him?
That's why Bessent wouldn't want it, I don't think. I mean, you know, to me, it's being in the Treasury Secretary means you're in the room.
So the other thing is Breitbart's John Carney has actually promoted your name to open up potentially if a board seat opens up. Is that something you're seriously considering?
I mean, I haven't. No, I mean, I'm very happy with the job that I have. It's nice to be considered, but you know, these are jobs that require you not only to have advocates on the outside, but also advocates on the inside. But I do agree with the idea that the Fed needs out-of-the-box thinking to support the new chair. You know, this is, you know, sometimes it's way too much of a consensus building type of institution. I think it's healthy sometimes to have like an open and vigorous debate and just let the chips fall where they may.
Neil, we don't do endorsements here, but if we did, Neil Dutter of Rentmac. Neil, thank you, sir. Appreciate it,
it's out
as
there
always.
in the ether.
You knew that was coming, didn't you?
Yeah, he told me. This was his argument all week when I was asking him about it. So then I looked up who were the first few. And Charles Hamlin actually was a lawyer, very Powell-esque.
Very Powell-esque. The Treasury Secretary, Scott Bessent, as you know, knowing the guy personally, he's very proud of having this position. He refers to himself often in all these conversations he has with the media as an economic historian or a student of economic history. That's where he wants to be. Now, I know a lot of people here on Wall Street would like to see him also as the Fed chair, but I think that's the view from people inside the conversation with Bessent at the moment.
I didn't get a sense that he wants to move to the other side of Washington, D.C. anytime soon. He's very happy with the position he has, and he also said that in testimony in Congress. But of course, there are people who think he's doing a really good job and prefer to see him at the Fed.
Can we imagine Dutter on the FOMC? I think we can.
I think that would be, he'd be a rabble-rouser. He definitely would. I'm just still trying to imagine the musical with Scott Bessent and what the songs would be. I'm trying to have it, you know.
You do you. Go at it. We've got a commercial break coming up.
Good, so I could just sit here and do
Have
that.
a think about it. It's Friday.
Yeah, well, you know, one thing that I didn't ask Neil Dutter that I'm actually curious about, if they cut substantially, would that help the housing market? How much would that actually contribute that? And that, I think, is one of the key questions. If you don't have, to your point that you were asking yesterday, John, if you don't have a credible Fed chair, do you get the results that you ultimately want if you do cut?
I would say, look, you know, the market gets a vote on this before the Senate does, and ultimately you select the wrong person. It makes it harder to cut, not easier. Up next on the program, Seema Shah of Principal Asset Management, Monica Guerra of Morgan Stanley, David Miracle of Goldman Sachs, plus Marissa Adams of HSBC. The second hour of Bloomberg Surveillance up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors. When they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The economy is amazingly resilient in the U.S.
Don't confuse Wall Street, i.e. the S&P 500, with Main Street, i.e. the broader U.S. economy.
It is very clear in the data that the U.S. economy is slowing.
Consumers are still very worried about the future.
If you start to see labor market weakening, then for sure you will see the Fed act.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now with equities that far away from all-time highs on the S&P 500 after the close yesterday. Your scores look like this. Equity futures positive by 0.25%. We had some weight to the rally on the NASDAQ 100, up by 1/3%. Things are better across 3 dimensions on trade, taxes, and geopolitics, and that's why we're within striking distance of a record high. Later on this morning, 8:30 Eastern Time, more economic data. Core PCE just around the corner, following a pretty big rally at the front end of the yield curve so far this week.
There's been a belief that you can get disinflation without the weakening in the economy that so many people have been worried about. Yes, we are seeing a weakening. It is not being perceived as weak. It is not being perceived as this labor market actually breaking. And if you see spending continue relatively strong with inflation coming in, how much fuel does that give to this feeling that the tail risks keep getting removed?
And the White House with a much more relaxed posture leaving Q2 than how they came into Q2. April 2nd, a lifetime ago. Going into July, things feel a whole lot better.
So no one thinks we're going to go back to those tariff rates we saw on April 2nd, Liberation Day, because there will be, at least in principle, deals with a number of trading partners. But will they come by July 9th? I think that is still some of the risk we're seeing, because I'm not sure you can get all these partners done in a week and a half. But I think people need to be cautious. Yes, a bill will get done. Yes, trade deals will get done. But it's not so neat right now. We haven't had a single trade deal being announced since the United Kingdom. This idea of a framework with China only hosts a few issues. And then when it comes to the one big beautiful bill, July 4th is 1 week from today. The text is still with the parliamentarian in the Senate, and they are striking down a number of issues. There is a lot of hurdles and churn that Washington needs to go through.
Lisa was talking about the data. Weakening maybe, but not weak. Look, on these situations, trade and taxes, things might not be great, might not even be good, but they're better. They're better than where we were just a few months ago.
And it raises a question, is that enough? Is that enough to keep reaching new highs, just that it's not as bad as it could have been? If you take the tail risks off, do you have something that can keep accelerating going forward? And ultimately, that might be the biggest question, because you do see the potential for margin compression as companies increasingly absorb some of these costs. And there are real questions about how much more consumers are willing to absorb when you hear a number of retailers talk about having to downgrade or even withdraw some of their earnings estimates. So the jury's still out, not necessarily whether there's going to be Armageddon, but whether there's going to be a greater degree of profit margin weakening that is going to erode some of the euphoria.
And when you talk about tail risks being taken off, even just last night, the Treasury Secretary announcing that they're getting rid of Section 899 because they did a deal with G7 leaders. That was something that people were very concerned with abroad. Would individuals, investors, big firms want to continue to invest in the United States? That's one risk already being taken off. So to your point, maybe it's not great, but it certainly is better.
The mood music improves. On regulation, on taxes, on trade, on geopolitics. Then you go into the third quarter and you start to focus on the labour market data just a little bit more. You've been bringing this up all week, Lisa. I'm right there with you. If you're reducing interest rates because you're seeing these disinflationary trends, you're not getting that tariff bump that everyone was worried about 2 months ago, that's one thing. If we start talking about interest rate cuts because this labour market is starting to crack more than that, then you've got a problem.
And that's, I think, what people are not counting on. And that, I think, is really the ultimate question for the remainder of this year. Can you have the stasis that we've seen in the labor market without an eventual further weakening that does show up in terms of sentiment, in terms of spending? I keep looking at recent college graduates and the fact that their unemployment rate is about 10% or higher and has been climbing. And when you take a look at that, you just wonder, what is really the message in terms of how dynamic this market is? Neil Richardson was talking about that yesterday.
It sets us up for next week. Payroll's just around the corner. Next Thursday, remember, Friday's a holiday stateside. The estimate in our survey so far, 120. The estimate is 120 as we put those estimates together. The previous number last month, 139. Coming up this hour, we'll catch up with Seema Shah, Principal Asset Management, with stocks pushing towards all-time highs. Monica Guerra of Morgan Stanley as the US and China confirm a trade deal is on the table, and Marissa Adams of HSBC on the prospects for an agreement with Europe. We begin this hour with stocks inching towards a record. Seema Shah of Principal Asset Management writing, the valuations are fairly unattractive, but investors may gradually re-risk if news flow over the coming few weeks is constructive. Seema joins us now for more. Seema, welcome back to the show. The pain trade, so many people have talked about it. Is the pain trade still equities higher and leadership a whole lot narrower?
Hi, John. Yeah, I think it is. I mean, I think when we're certainly when we're looking at the economic backdrop, and you're right, things have improved from April, but when you're comparing it to January, you've seen economic growth downgrades, you've seen inflation forecasts being pushed up, you've got tariffs ultimately ending up at a higher level than when they started the year. So does it really make sense for equities to be hitting new record highs? I think that is a pain trade. For the next 3 months, I think if you're looking out over a 12-month period, actually, I think that things can be a little bit more constructive. So if you're taking a long-term view, then certainly being risk-on. But in the near term, I do think there's a couple of potholes, bit of volatility to come.
Seema, take that 12-month rolling view of things, of the world. Why do you think things improve 12 months out?
Well, I think generally, look, we have got some concerns about the labour market cracking, but we're not seeing many signs from either large businesses or even small businesses that they're planning to introduce major job cuts. We do think the Federal Reserve will eventually start to cut rates. The general picture is one of a fairly modest growth world, but you just need modest growth in order to have earnings growth, and therefore to push up risk markets. So I think overall it's a fairly constructive outlook. It's just not as constructive as maybe you had in 2024 or 23.
Seema, the one constant has been, and it has been a change since February 19th, is that we've seen dollar weakening. And that has been a consistent story, even with this V-shaped recovery that we've seen in both the S&P and the NASDAQ. At what point does that hold in terms of an asset allocation point of view? In other words, the rest of the world still looks better than the U.S., even though the U.S. has shown a great degree of resilience and a lot of tail risks have been taken off the table.
Well, actually, I think that a lot of that is starting to lose a bit of momentum. In Europe, for example, of course, it's done wonderfully, a lot of optimism in discussions. But now you're getting to the point where investors are saying, well, look, show us the money. When is Europe really going to implement? When are you going to see infrastructure? When are they realistically going to talk about deregulation? And then once they start to see that, which of course could come at any time, but realistically as Europe, things start to take a bit of time. If you do start to see that, then I think there's more of a secular growth potential coming through in Europe. So I think for the time being, we're almost reverting back to the US. in terms of certainly allocations, we're still very much overweight risk U.S. assets.
So, Seema, if you're allocating back to the U.S., is it on a hedged basis, or is this unhedged back to the old playbook? Because it looks like maybe some of the statements of the U.S. exceptionalism's death were vastly overstated.
Yeah, to your point, I think a lot of those concerns were overstated. I don't think that narrative is necessarily going away, and we are, for example, expecting further dollar weakness over the coming months, quarters, because some of the shine has certainly been taken off the U.S. There's a real spotlight on the deficit, and of course there is greater potential. It's still potential. It's not real at the moment, but it's still greater potential in other parts of the world. So I think there's a continued decline in the dollar, but I think that the U.S. exceptionalism story for now is still intact. It's just that there's growing questions. And for other countries around the world, this is probably their moment. This is the moment that they can take the bull by its horns and maybe improve their growth prospects over the long term.
Seema, in your latest note, you talk about still tariff concerns and shipping costs that could derail the normalization process when it comes to inflation. When you look at all the uncertainties that are in Washington, D.C., is that the one that you want them to get a handle on as soon as possible?
Yeah, I think so. I mean, I think for companies, look, all companies will eventually adjust to trade uncertainties. They'll find their ways through the supply chains. But you are seeing that companies are holding back on investment plans still. They're holding back on hiring because they just don't know what's coming. Now, in the next couple of weeks, will we find that clarity, that certainty with regards to tariffs? I very much doubt it. I think that over the next 18 months or so, you're going to see this back and forth, potential resumption of hostilities occasionally. So I think that we almost have to get used to this lack of certainty, which unfortunately is going to weigh on businesses. I just don't think it's going to be the point that they start to capitulate entirely because of this uncertainty.
But you're confident that we're not going back to the maximalist approach we saw in early April?
Yeah, I think so. I think the administration has learned a fair amount from that experience. I mean, 145% tariff, that's almost the kind of the stoppage of trade between the US and China with major implications on US growth. So I think from that perspective, that's not something they want to go back to. But we are going to have higher tariffs than what we started the year. We're expecting an average effective tariff rate of around 14 to 15% by year end, and that's up from 2% at the beginning of the year.
Seema, just before you go, you're in London, I believe. Just to reflect on the last few months and the changes in behaviour and attitudes towards US assets. Price, of course, shapes narrative. It also conditions behaviour. And I just wonder, from your standpoint, the conversations you have every day in Europe, have you seen a permanent attitude shift towards US assets? Or with this rebound, is it bringing the attention back to America and, dare I say, American exceptionalism all over again?
It's an interesting question. So I think cyclically, people are starting to look back to the US because they've seen that the market rebound. There's hope still about technology, etc. But I think that there is a structural decline in the US because there are genuine questions about the reliability of the institutions, not just within the government, but in terms of universities. And that is weighing on people's perspectives. So I think cyclically we're okay in the US, but structurally there is a conversation going on about looking outside of the US more domestically, and I don't think that conversation is going to go away anytime soon.
Seema Shah of Principal Asset Management. Seema, thank you, as always. Of course, this is playing out in the FX market, that dollar story, dollar a whole lot weaker over the past few months.
Yeah, and I wonder how much that actually has the opposite effect of bringing people from the EU to the US. I mean, think about it, everyone who went to Southern Europe to have a vacation because of how strong the dollar was, well, come over to our house. There's sort of that kind of feel, and you do see that in some of the foot traffic, at least anecdotally.
117 will do that.
I think so.
You're hearing the accents and the languages in Midtown Manhattan.
I mean, the air train out of control. I mean, you're just definitely seeing this sort of percolation of new tourism flows that come on the heels of a weaker dollar.
Terrible quarter so far for the US dollar, down I think about 7% so far on the quarter. Still a couple of sessions to go to round out Q2. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira with more. Hey, Yahira.
Hi, John. Iran is denying it's holding nuclear talks with the U.S. next week. President Trump had said days ago there would be negotiations, but Iran's foreign minister told state television that speculation about new discussions should not be taken seriously. He added that damage from the U.S. attack on its nuclear facilities was considerable and serious. Meanwhile, the U.S. Treasury Department has reached a deal with G7 allies to exempt American companies from certain foreign taxes. That's in exchange for removing the so-called revenge tax proposal from President Trump's tax bill, which had raised concerns on Wall Street about discouraging foreign investment in the U.S. And Indian authorities say they have extracted data from the 2 flight recorders retrieved from the Air India jet that crashed 2 weeks ago. All but one of the 242 people on board the Boeing 787 were killed when it crashed just seconds after takeoff. The cause of the accident remains unknown. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes from now. Up next on the program, making progress on trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. I think we could get a deal done now. Europe will be right at the end.
More on Europe and on China in just a moment. China, what deal? Monica Guerra of Morgan Stanley will explain that in just a moment. Live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Live from New York City this morning. Good morning to you all. Heading towards the weekend. Just one more trading day to go. Very close to all-time highs. Your day ahead looks like this. 8:30 Eastern Time. Another data point for you. Core PCE. Look out for that a little bit later this morning. Personal income and spending data important as well. And then a snapshot of the economy and consumers. Or is it just a snapshot of how they feel about politics right now? UMich Consumer Sentiment. 10 a.m. Eastern Time. That's how the stage is set this Friday. Going into a market that looks like this Friday, following Thursday's price action, 0.05% away from all-time highs on the S&P 500 this morning. We're looking for record highs at the opening bell. We're up another 0.25% on the S&P. On the Nasdaq, up by 0.4%. Under surveillance this morning, we're making some progress on trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. That deal was signed and sealed 2 days ago. I think we could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partners, so the fact that they come at the very end makes some sense.
Here's the latest this morning. The U.S. Commerce Secretary Howard Lutnick indicating the U.S. has plans to reach agreements with 10 major trading partners after it finalized the deal framework with China. Joining us now to discuss is Bloomberg's Mike Shepard. Mike, what's the difference between a deal, an agreement, a framework for a deal? What has actually been agreed with China?
Well, it's a great question. It's the one we're all asking this morning here in Washington, and certainly in Beijing probably too. We're trying to figure out what exactly the terms of this are. We've gotten really, from Howard Lutnick on our airwaves last night, the broad strokes of what was agreed to between the world's 2 largest economies. And in essence, China is promising to remove some of the barriers on exports of rare earths, which are needed in everything from wind turbines to airplanes to night vision gear, all sorts of products across the economy. They will remove those barriers, and in turn, the U.S. will lift some of the restrictions it had imposed in the past few months on exports of certain technologies to China. That includes chip design software. It also includes shipments of ethane, which is a critical element in making plastics. So we're waiting for the two sides to actually follow through on what they signed 2 days ago. And Howard Lutnick made clear that the U.S. will only actually lift those barriers once it sees actual physical progress on the exports of rare earths to the U.S., to trading partners here, to companies that are looking to buy these elements, these rare earth magnets. This includes the auto sector as well, which has been complaining vociferously about a lack of progress in this area, John.
Hey, Shep, the market's moved on from a lot of this and moved on pretty quickly. You live and breathe this stuff down in Washington, D.C., in the nation's capital. Is it fair to say there has been a shift in the mood music over the past few weeks, less aggressive on trade, less aggressive on things like the revenge tax as well? Is it fair to say we have seen that shift?
We certainly are seeing something of a shift, and there was a recognition that the revenge tax really posed an issue for Wall Street and for businesses overall as they look at the U.S. and decide whether this is going to be a good place over the long haul to invest. Things like the revenge tax actually emerge as a barrier to that kind of investment, and the signaling on it really came very quickly from the investment sector, and that really prompted the Treasury Secretary and leaders on Capitol Hill to back away from that provision. It was a source of grave concern. And you're also hearing, when it comes to trade, John, Howard Lutnick indicating that he really is trying to reach a deal with the European Union. This is the largest U.S. trading partner. It is going to be a very tricky one. And remember, if they don't reach an agreement, the reciprocal tariffs on European imports into the U.S. will rise from the current baseline of 10% to 50%. So there's a lot at stake there. Even so, there are, as we heard from our colleague Oliver Crook in Brussels just now in the past hour, there are a lot of misgivings in the bloc about how they proceed and whether they're at risk of getting some sort of asymmetric deal with the U.S. Remember, while we're seeing a little bit of easing on trade and on tariffs, there is still the prospect of sectoral tariffs on whole categories of goods like semiconductors, pharmaceuticals, and lumber, John.
Hey, Shep, appreciate the update. Thanks for making time for us. Mike Shepard there of Bloomberg down in Washington, D.C. The language is different, no longer nasty. Do you remember that? Europeans are nasty. Nastier than the Chinese, apparently.
I was pretty taken aback and surprised on how nice the president was in terms of the European leaders when it came to NATO language, saying this is not a ripoff. These are people who love their country, and we should help defend them. This is all part of the program. But when it comes to the European Union, this is going to be challenging because this administration is not just looking at trade barriers, looking at non-tariff barriers as well. But I know Shep is talking about July 9th, potentially those higher tariff rates come back. When I spoke to the Swiss trade ambassador, they said that they have been given reassurance after reassurance that if a deal is not there by July 9th, there will be extension. So the cans will be kicked.
A lot of deals to be made in the next few weeks. Monica Guerra of Morgan Stanley joins us around the table. Monica, good morning.
Good morning.
July 4th, July 9th. The 4th for taxes, all self-imposed. The 9th for trade. How are you setting up clients going into July?
I think I'm just really trying to focus on the positive, right? That we've passed that peak uncertainty a while ago now. We have more known unknowns, more known knowns, and that we're going to get more clarity, right? We're thinking about moving cash off the sidelines and back into markets. Now, for the 4th, one of the questions I get all the time, right, is are they going to do it? Are they going to make this deadline on the tax bill? And, in our opinion, we think we're going to get some text to look at. We'll actually have some movement in what the final Senate package is comprised of, and that, includes everything from, cuts to taxes. The other piece of this whole equation is on the, trade and tariff front. And so we're watching that, very closely like everyone else. But there are some interesting interplay between the tax bill and tariffs at this time.
To John's point, the mood music sounds better, but this seems like positive vibes. What is tangible? When the Commerce Secretary says they have a deal they signed with China, what is the United States giving up to get those rare earths? Do we really know?
We don't, right? I think we're all looking at sort of the black box right now, waiting as this information comes out. Even the rare earths information is fresh, right? If we're thinking about this morning and getting more as we go. For us, what we're looking at is more of those non-tariff trade concessions, like you're saying. We do think that LNG is going to be part of that discussion, as well as defense. So we think that we're going to have not just increased U.S. demand from future bills and spending, right, but also more export demand, right, for our stuff.
This is really important. The idea of what do these deal negotiations look like? It's not necessarily the traditional, you lower your tariffs, we lower our tariffs. It's, you know, if we lower our tariffs, will you buy this many Boeing airplanes plus this many B-2s and this many whatever else? And that's really a question. You think that there is a lot more to go in the energy space. Can you go through where that hasn't showed up as much in the price action, where you see that to really play out for the remainder of the year?
Yeah, I mean, I think right now, from a price action perspective, we are seeing, you know, MLPs outperforming, because that's part of the LNG story, right, as far as exporting and making sure that that's, you know, moving in a smooth direction. We do think that there's going to be over a 5% increase in demand domestically this year, and then you have to layer on, right, all of the geopolitical factors around LNG specifically. The other thing that I like to hit home on, and this brings it back sort of full circle to the tax bill, is that the Inflation Reduction Act provisions are actually not being rolled back at the rates that were originally expected. And one thing that I've come on here and sort of pounded the table on and continue to pound the table on with clients is that clean energy continues to outperform traditional energy. This happened during Trump 1.0, underperformed during the Biden administration, now outperforming again. We do think it's part of a rate, but also this desire, a rate story, but also the desire, right, to keep oil prices low.
So this is also fascinating because it seems like we're playing whack-a-mole with different sectors. We were talking about the auto sector getting really hit by the tariffs. All of a sudden, GM and Ford were the main players. Are we shifting our focus increasingly to the energy space? We hear President Trump coming out saying, if you don't lower your prices, you're letting them win. You're going with the bad guys. I mean, we've heard this type of rhetoric, and yet a lot of people in the shale patch have been really hurting in terms of their profitability because prices have been low. What does this look like in the remainder, at least of this term, but even this year?
There's one of the things that I think is important if we're thinking about supply domestically. There's not much that the U.S. can actually do. So if we're thinking about tax credits or any kind of give back or break that the Trump administration could provide or Congress could provide, it's not going to be enough to actually incentivize more production. And so that is really important to hold on to, that this is a macro market and it is not, we have very little control. Now, oil prices over time have stabilized in the U.S., right, because of the Strategic Petroleum Reserve and other tools that we've used, but we have actually very little sort of moment-to-moment control over those prices. So maybe we get some reduction actually around the elections and midterms. Maybe that's sort of the moment where we see an actual decrease in costs materially for folks.
Monica Guerra of Morgan Stanley. Monica, thank you. Appreciate the update from you on two key deadlines going into the next couple of weeks. July 4th, we're looking for an agreement on taxes down in Washington. Then July 9th, we're looking for some agreements, and I stress some, on trade. Coming up later, just look out for this. Just a quick programming note for you. 8:15 Eastern Time, we're catching up with the Energy Secretary, Chris Wright. And I imagine you might have some question for Secretary Wright on energy and on this story a little bit later.
Well, there's this feeling you want to boost the energy sector in the United States, particularly with AI, and there was another story coming out of Reuters this morning about that. At the same time that you're seeing rig counts go way down because prices aren't high enough to justify their production. So a real kind of conundrum wrapped in an enigma.
Is that what it is?
It is.
In a riddle? What's the next line?
Yeah, something like that. I don't know. I'm not doing well with
Yeah, I forget. It's Friday. Whatever. All right. Secretary Wright coming up in about 50 minutes' time. Look out for that conversation. Up next on the program, David Miracle of Goldman Sachs. Plus, Danny Berger with your morning movers. Estee Lauder rising on an upgrade from HSBC.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We're looking for record highs at 9:30 Eastern Time at the opening bell on a US benchmark. Equity futures right now adding some weight to the recent rally, up another third of 1% on the S&P 500. On the Nasdaq 100 up by 0.4%. This is a big tech-led rally. Michael Hartner of Bank of America saying the participation has been really quite small. Only 22 S&P 500 stocks currently at a record, even with the index within striking distance of all-time highs. Something to think about the index level. Beneath the index, some single names for you. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. If you're worried about breadth, we do have some consumer stocks outperforming this morning. Nike, one of the best performers in the S&P pre-market, down up 10.2%. They had earnings yesterday. They beat expectations. Yes, they had a drop for the current quarter in their forecast, but less than expected. The hope is that the worst is behind Nike, that the CEO has done enough work turning around this company, focusing on sports, getting down their inventory to right-sizing that, so those shares rallying. Also, another consumer stock on the up this morning is Estee Lauder. Those shares up 2.6%, an upgrade from HSBC. Three things going on, say the analysts there. One, consumers in China are normalizing. Two, a weaker dollar. And three, continued American resilience. So that helping the shares this morning. Meanwhile, Lisa mentioned this story before the break. Reuters exclusive reporting that according to sources, the Trump administration is looking at helping more power supply getting to the big AI players. That means things like making it easier for some of these energy names to connect to the grid, the use of federal land for AI data centers. So again, all the energy names up pretty sharply. Constellation probably the best this morning, up 2.7% on that story, John.
Danny, thank you. More from Danny in the next hour. Just a repeat programming note for you, 8:15 Eastern Time. The Energy Secretary, Chris Wright, joining us on the program in about 44 minutes from now. So look out for that conversation. We're behind on this, aren't we? How many times have we been told we are behind, making sure we've developed energy infrastructure to such an extent to back up what we're already seeing in capex from the major tax players?
Yeah, and you wonder what form that's going to take. New York State talking about somewhere in the state having a new nuclear plant. Is that going to be one of the paths of travel as we see a 3-point mile getting regenerated? And this question of how are we going to power something that clearly is powering the stock market and powering a lot of the exceptionalism dreams for the United States?
We'll pick up on this program now in just a moment, about 45 minutes away, a conversation on energy with the administration. On our radar this morning, one of our top stories, the US and China reaching a trade deal. China echoing Commerce Secretary Howard Lutnick, saying a trade framework is on the table. Lutnick also telling Bloomberg the White House has imminent deals with 10 major trading partners.
So when it comes to the 10 major trading partners, the president mentioned India yesterday, so maybe that's one of the first few. And then Howard Lutnick, the Commerce Secretary, is talking about how the European Union, obviously they need to get a deal done, massive trading partner for the United States, but it might be one of those deals that gets done a little bit later or pushes down until later into the summer. When it comes to China, I'm still scratching my head. Exactly what did they sign? Who signed it? Is just what they discussed in Geneva and London? That's not exactly a trade deal. It's an understanding on a few issues, rare earth minerals, and then what is the United States giving up in lieu? The Chinese side said the U.S. side will correspondingly cancel a series of restrictive measures taken against China. Well, which restrictive measures?
There are a lot of questions. There are more questions than there are answers. I do think, though, the salient point here is something that you've mentioned several times, John. The mood music has dramatically changed. It's gone from eat your vegetables to maybe let's start talking about candy. And that really is the question, you know, not only the tax deal, but also this question of what industries are going to benefit from sales to other countries that are part and parcel of these deals. I mean, I really think that's where...
On inflation for a Federal Reserve that is looking increasingly divided going into July.
And the expectation is for the ongoing disinflation. In other words, numbers that give the Fed a reason to cut because the inflation is coming down, although some people would argue they're a forward-looking mechanism, and so they have to look at what the effect of the tariffs have been, and that has been the argument for them. We also get personal income and personal spending. And on some level, that might be more interesting. Are people actually cutting back their spending in response to some of the potential price hikes on the heels of tariffs?
We've seen some of that softness start to come through the economic data. I think you can say we saw it earlier this week in consumer confidence. When consumers are asked at the moment, do they see jobs as being plentiful? We're seeing fewer consumers right now that believe that. When you look at jobless claims, things got better this week. But continuing claims speak to the idea that if you're not with a job right now, if you're without a job, it's harder to find a new one.
Yeah, it's hard to be overly rosy about the economic backdrop when you're looking at continuing claims at the highest level going back to 2021. This means it is a very difficult market once you are out of work to get back in relative to where it has been over the past couple of years. What people are coalescing around is there isn't that tail risk that's going to torpedo the U.S. economy into recession. Companies are adapting and adjusting, and consumers feel bad, but they're not exploring that when it comes to actual behavioral shifts. And that, I think, is what people are getting enthusiastic around, plus the fact that AI spend continues.
True. Another read on the consumer later on this morning, then. Look out for UMich consumer confidence. Another read on the labour market next week on Thursday. Remember, Thursday is the date for the payrolls report. It's a holiday on Friday. Might not be a holiday for those of you down in Washington, D.C., because there is a key self-imposed deadline. July 4th, Independence Day. They're pushing to get this tax bill passed.
Quote, we hope, is how the president put July 4th. We hope that we can get the one big beautiful bill done by July 4th. Look, this gives them a week to basically finalize the text, an agreement in the Senate, then go back to the House, where it's going to be challenging for some of these House members to agree from the edits from the Senate and then get it to the president's desk. Of course it could happen. Is it unlikely? Yes.
They're saying all the right things at the moment, though.
They are,
saying all the right things on taxes, on trade, too. Can you explain to the audience what the agreement is with China? Do we know?
The agreement with China, we don't have the text yet. We don't know who signed it. But the agreement is in reference to the talks in Geneva and in London about the issues of rare earths and those licenses coming from China and some of the export controls, revoking of student visas from China, potentially from the United States. But again, we don't know exactly what the U.S. decided to unwind to get this framework that they said they signed this week. The president said that, and so did the Commerce Secretary.
The market doesn't care about the details. Just seems to care about the mood music, and the mood music has improved.
Yeah, and honestly, at this point, no one's expecting to get details. Let's be really honest. Does anyone actually get to expect answers to all of those questions that a deal is
I'd like to read it.
Sure. You also said that maybe it's not going to be a vacation, John, for people down in Washington, D.C. Let's make vacation great again. I just think that we should start that motto. I mean,
sounds European. No thanks.
Shots fired. Who at?
Europeans. Not sure. I personally stand by it. Sometimes, you know, you're in Europe for 2 days and you're like, wow. They just don't have the same, as Eric Adams would say, focus and grind as America.
Do you want to carry on?
That's it.
Look, I've been here for the best part of a decade now. I love this country and the American work ethic. And when I go back to Europe, I do feel like there's a real divide between what the Americans do and what the Europeans do. I'll leave that there. But to your point, you're back for like 2 days in the summer, and I'm like, they've got this down. This is the way it should be done. Take August off. Just take the whole month off. Shut it down. Just close the market.
I've already basically booked it, so, you know, see ya.
You're not getting a good exchange rate.
117. It's not too bad, is it? It used to be like 140.
I know.
10 years ago. Anyway, euro dollar at the moment, 117. Equity futures up by 1/3% on the S&P. Coming up this hour, Julie Beal of Kane Anderson Rudnick with stocks on the brink of record highs. U.S. Energy Secretary Chris Wright, as President Trump changes his tune on Iranian crude. And Alejandra Grindal of Ned Davis Research reacting to the latest read on inflation. We begin this hour with stocks higher on trade deal optimism. Julie Beal of Kane Anderson Rudnick writing, the looming deadlines on trade and the budget can create a ton of volatility in the market. That makes it a nice time to add some quality to portfolios. Julie joins us now for more. Julie, welcome to the program. Just kind of framing July, going into the 4th, going into the 9th. Had a guest on earlier that said, get ready for some volatility. Do you agree with that?
Yeah, I think there's a lot of potential. We know that when we've had big movements in trade deals, that it does create a lot of volatility. It does create a lot of noise. And I appreciate that, the Trump administration has talked about, the deals that they've signed, but they're MOUs. They don't have a lot of teeth. They don't have a lot of details. And it's very hard to feel, if you're a business, that you can really plan around these 90-day increments. And so I think that what you'll see is quite a bit of movement in terms of inflation data, employment data, and eventually earnings. Those will come back at some point.
So if we could just frame the past 85 days, we've seen this whole round trip in equity markets from record high to 20% lower to record high again. What has really changed? How much have we seen just the idea of extreme negotiating tactics, then taking off the boil, maybe being a little bit more sanguine about the risk? And I'm talking about the White House, faced with the backdrop of a U.S. economy that keeps chugging along with a little bit more weakening around the edges, but the AI story is still intact. Basically, not that much has changed. Can we say that?
I think you can absolutely say that. I think really genuinely not that much has changed. No company really can feel super confident making large decisions in their supply chains right now because it's just too much uncertainty. So what you're seeing are these weird bolus where if you check the ports data, right, and you see the shipments coming in, you see these huge movements where up and down, and that creates a lot of friction within our supply chains, and that adds costs. You don't even need a lot of inflation or tariffs to create that. You're just creating a lot of inefficiency. And so someone has to pay for that inefficiency, right? Someone has to pay for the tariffs in the same way. And I don't think that's super reflected in valuations overall, particularly for companies that have more cyclical sensitivity.
So can you give us a sense of how you're understanding the progression of this trend of people not fully appreciating the cost of those frictions in the data that we're going to be getting? In about 23 minutes, we're going to be getting personal income and personal spending. Do you expect to get the first signs of that by consumers retrenching or their incomes coming down? I mean, can you see it in the personal balance sheet yet? Or is this something that isn't going to materialize for, say, 6 months?
I think it's actually going to take time, right? Because you're seeing the income effects that are playing out at different levels. So for the low-income consumer, we are already seeing the stress. We can see that in a lot of the dollar store commentary and Walmart's commentary. We know that there's stress there. Strategas does this great analysis of Google searches in terms of bankruptcy and personal loans, and they've seen a real increase in that. And that's concerning to me, right? Because you can't really fix a lot of this balance sheet situation with more debt. And so I worry that we're getting to a place where consumers are feeling a little bit stressed and they're not really able to get in and out of the housing stock with interest rates where they are. So it's hard to see where they're going to get the level of relief that they need. And when we have an economy that's really driven by the consumer, that also makes it difficult to drive a lot of earnings growth.
Do you think we're going to finally at some point see whether or not it was just front loading of individuals buying up a bunch of materials?
I think it takes time. If you listen to businesses talking about the front-loading effects, it's really hard to know exactly when and where those are. You have a lot of inventory that's actually being held at the ports because companies aren't sure when to take them, right? So there was a whole blow-up of inventory there, and eventually people recognized, okay, I'm going to take it because the tariffs on China have gone down. So it's very, very difficult, and there's going to be a lot of noise. I think we were expecting, okay, the noise is going to quiet out through the summer, and now I'm not so sure. I think fourth quarter is actually when you're going to have a much better sense of what the true run rate and the earnings power that is underlying a lot of these businesses.
You've been so focused on tariffs and what's going on with trade. When you hear the Commerce Secretary say we signed a deal with China, is that noise to you?
Yes. I mean, we still don't have a lot of clarity on terms of what these agreements are, right? Like, I have an MOU with my wife that I'm not going to drink too many margaritas tonight, right? That doesn't mean that that's actually what's going to happen. And I think that's the problem with these MOUs is we talked a lot about them happening before in terms of the rare earth minerals, and then we hear, oh, actually, no, those are being withheld. So it's really hard to feel like you can sink your teeth into a lot of the deals that are being struck because they keep seeming to walk back and walk forward from them.
I promise we'll let you go in just a moment so you can get started early, but just one more question, Julie, okay? What's your approach to the next couple of months? Where do you want to be in this equity market? Would you fade the gains we've seen in big tech, or do you want to stick with it?
I think that there's still really good, strong secular growth that's happening in big technology. And so to me, you can continue to hold positions where valuations aren't too overly stretched. But I think you want to be adding some more defensives in terms of healthcare stocks or very high quality, financials and things. That's really where I think you want to be, is to have some real earnings durability that you can feel confident about, because I do think that there is less clarity to earnings progression over the next 12 months than we've had previously.
Julie Beale of Kane Anderson Rudnick. Julie, cheers to that. Enjoy yourself. All right, just for the record, this is just warm water.
No one thought
all right,
that it was
there's nothing else in that. All right, but when TK was on the show,
never knew. As a viewer, I never knew.
When TK was here,
Could make Fridays fun.
just a bottle going around the table.
Oh,
at
yeah, big
times.
time.
You know? All right, let's
Great
get you an
story.
update on stories elsewhere with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. A trade deal between the U.S. and China was signed 2 days ago. That's according to Commerce Secretary Howard Lutnick. In an interview with us, he said the deal codifies the terms laid out in earlier talks, including China's commitment to deliver rare earth minerals. We also heard from China this morning, which also confirmed the framework. Meanwhile, a bright fireball lit up the skies over the southeast on Tuesday, and it's believed to have been a meteor. People across Georgia and the Carolinas say they saw it streaking overhead with smoke trailing behind it, followed by a loud boom. One fragment reportedly even came crashing through the roof of a home in Atlanta. And this story is finally getting its own brief. Wedding celebrations are underway in Venice for Amazon founder Jeff Bezos and Lauren Sanchez. But the event has reportedly been relocated to a more secluded part of the city to avoid protests. While details remain under wraps, the guest list is set to include up to 250 people, with the festivities reportedly costing as much as $55 million. A drop in the bucket for Mr. Bezos. That's your Bloomberg brief, John.
Yahara, thank you. Unbelievable. 55 million. 250 guests.
Yeah, I was looking at that, and I was looking at the outfits and the different people and coming in.
55 million is a little grotesque for a wedding. I'm sorry.
You've got something to say.
You
You're looking at the outfits.
You didn't like her Skipperelli outfit?
What didn't you like?
Well, it wasn't that I didn't
There's
like it.
a vacancy at Vogue now, so this is the pitch. Go.
Okay, it's just that trend where you make your waist disappear. I don't understand physically how that happens.
The Victorian era trend.
Yeah, like the corset. But it's really, it's reached some extreme levels, and let's leave it there. And
Looks uncomfortable.
I know. At the same time, it's just sort of a medical marvel.
Would you like that position over at Vogue?
It's couture Skipperelli. It's not a medical marvel.
Nobody wants
we
to
know
see
who
that,
is.
John. How can you
Take
imagine?
over from Anna Wintour.
Yeah, that would go down.
Sign me up.
That'd be cool. All the tickets she gets to go to all the good stuff.
Oh, it'd be totally cool.
Every sporting event, I always see her at the tennis.
Except everyone would be wearing your nothing.
And the clothes. You get all these free clothes.
That's true, you get free clothes too. All right, futures up by a third of 1%. Up next, the Morning Calls Plus. The US Energy Secretary Chris Wright, as the president pushes for a shift in global energy. That's next. This is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators.
Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Just in case you were interested, the conversation on the Bezos wedding continued for the last 2.5 minutes. Are you both finished now?
We're done.
You've settled this, okay?
We'll talk more Monday when we see who made the wedding dress.
Do you know who made the wedding dress?
No, I don't.
Got an idea of what it looks like?
I have my ideas.
I think we've got a decent idea of what this is going to look like.
Based on her past dresses.
Choices. Okay, all right.
Including at the White House.
Yeah. Okay, I'm moving on. You guys didn't move on at all. All right. Equities are positive by 1/3% on the S&P, up by 1% on the Nasdaq 100. We're high here across the board. In 1 hour and 13 minutes time, we're on record high watch, expecting to breach the all-time high on the S&P 500. Went through it briefly in yesterday's session. At the close, though, just short by 0.05%. That's the price action. Here are some morning calls for you. First up, HSBC upgrading Nike to buy, saying its margins will be, quote, repaired despite tariff risks. That stock is flying, up by 10.4% this morning. Your second call from Cantor Fitzgerald, raising its price target on Uber to 106, expecting autonomous vehicle developments to drive share performance. That stock is up by 0.2%. That's an interesting perspective. And finally, Baird downgrading JP Morgan to underperform. The firm not expecting the same level of returns as the last several years. That stock is down by 0.5%. Let's turn to energy. The US changing its tune on Iranian crude. President Trump posting on Truth Social earlier this week, China can now continue to purchase oil from Iran. Hopefully, they will be purchasing plenty from the US also. Joining us now to discuss the state of energy, not just domestically, but worldwide, the 17th United States Secretary of Energy, Chris Wright. Mr. Secretary, welcome back to the program, sir. Looking forward to an in-depth conversation with you about what you cover every single day. So first of all, just on Iran, so we can deal with that. What is the current stance of the US officially on the use and import of Iranian crude?
Oh, the sanctions are still in place. No change there. I think what President Trump was referring to there is, hey, if we make a large peace and sanctions come off, Iran can flourish.
Have you got a decent understanding, though, Mr. Secretary, of just how much Iranian crude is being consumed and imported already as things stand, despite the sanctions?
We do. So Iran produces about 3.5 million barrels a day, and they've been exporting about 1.5 million barrels of oil a day. And the maximum pressure campaign that President Trump did in his last term tamped that down to only 100 or 200,000 barrels a day. They cut off 90% of it. That was a possible strategy here as well, but hadn't been implemented yet. We tried to give negotiations a chance, see if we can do it without maximum pressure.
So is maximum pressure still on the table, or is the administration walking away from that?
Well, the goal right now, of course, is to get a peace deal, is to get peace into the Middle East and spread the focus on commerce, not conflict. So no, it's not actively being discussed right now, but the situation's still dynamic there. We want to see peace, prosperity, and security as the future of the Middle East.
When it comes to what's going on in Iran as well, in terms of the IAEA, the foreign minister said yesterday that basically they have no plans to having the Director General, Rafael Grossi, in Iran. And it doesn't sound like they're willing to give the inspectors the space, time, and access they need to look at these nuclear facilities. What is the United States' response to that?
Yeah, look, this is early on. This is early on. Iran has just had most of its nuclear program entirely devastated by Israel and the United States. They're a little bit humbled. They're a little bit shell-shocked right now. So, yeah, I wouldn't put too much weight on those words, but a final peace deal certainly has to have confidence in a dismantlement of the Iranian nuclear program and that people can have security it won't be resurrected in the future.
You deal with a lot of nuclear at the Energy Department. Before the U.S. strikes, but after the Israeli strikes, Rafael Grossi told us that the IAEA cannot verify whether 400 kilograms of 60% enriched uranium in Isfahan was currently where it was. Was it still there? Did the Iranians take it out? Doesn't the IAEA need to go in and verify where this enriched uranium is?
I think that's quite likely part of a future negotiation or a future deal.
Mr. Secretary, of course, this is just one part of the conversation in energy right now. I can tell you earlier on this morning, there's a report that you might have seen, it came from Reuters actually, that your administration is readying a package of executive actions aimed at boosting energy supply to power the U.S. expansion of artificial energy. Mr. Secretary, what can you share with us this morning?
Yeah, look, artificial intelligence is an incredibly exciting development that's coming. It is going to revolutionize not just our economy, but our health, drug discovery, but it also plays a huge role in national defense, which is why I've compared it to the Manhattan Project. It's critical, it'll be transformative, and we must lead. We cannot be second place in AI. And to do that, we have the scientists, we have the capital. You have to have a huge growth in U.S. electricity production. So we need to get the morass in the way that's really hobbled the American energy system for the last 4 years. And we got to unleash American investment and American capitalism. That's going to take building a lot of new power generation.
Mr. Secretary, to build on that idea, what type of energy production are you looking at? I know that New York State was just looking at potentially creating a new nuclear energy plant. Is that one of the paths of travel that you think is going to be pivotal for the United States?
Absolutely. Look, to have a secure power grid and to power AI, you need 99.999% of the time on power. And so that today, our biggest source of reliable power today by far is natural gas. Our second biggest source is nuclear, and our third biggest source right behind that is coal. So those are the three keys to the future of our electricity grid. Nuclear, we haven't built much for a while, so I was thrilled to see the governor's announcement embracing nuclear in New York. We have the governors of Tennessee and Georgia and Virginia passionate about getting new nuclear built in their states. So yes, one of our goals in this administration is to launch the American nuclear renaissance.
Mr. Secretary, how do you encourage this type of investment at a time where the goal of the president has also been to lower prices? And we've seen this particularly in the energy space, where the president has been very vocal about the desire to see energy prices lower. And this has led to a number of oil rigs in the shale patch to be taken offline because it isn't profitable for a lot of these companies to be producing as much as they used to. How do you sort of square that circle?
Yes, yeah, prices are supply and demand. Prices are supply and demand. But what we're doing in the administration is everything possible to lower the cost to produce energy in the United States. Cheaper to produce a barrel of oil or an MCF of natural gas, or a ton of coal, or a kilowatt hour of electricity from nuclear plants. So that's deregulatory, that's common sense regulation focused on health and safety and the environment, but not the nonsense that just burdens energy producers. Nuclear will be a little bit more expensive at the start, but I think that cost will be borne by hyperscalers. They want to see nuclear re-arrives, and they'll sign higher power purchase agreements to help kickstart nuclear. We need to grow the energy supply and keep costs down. You're right, that's a challenge. You're right to bring that issue up, and that's what I work on 7 days a week.
Let's get at the regulatory burden. We're lucky to have someone in your seat that's actually ran an energy company in this country. As you know, permitting is really difficult across many dimensions. You have to go state by state. Are there things you can do at the executive level to make this a lot easier? Could you describe those kind of things?
There are a number of things, and it is why we created the National Energy Dominance Council. That's really to bring people, leaders from all different agencies that impact the ability to build things in our country together, and say, we talk to producers and say, why aren't you building that? And they'll give us a list of 7 things. It'll take us 7 years, and we're really worried about this one and that one. So we dive into those issues and say, how can we simplify that? But I'll highlight a Supreme Court decision from just a few weeks ago on to get more oil out of Utah via train that had been held up for years through suits over NEPA, and the Supreme Court ruled 8-0. Every Supreme Court justice involved in the case said, yes, we need to put NEPA back in its box. It's to check to make sure the environment's being considered. It's not to have years-long, endless delays. Because if you delay something, you make it more uncertain, more expensive, and simply less things get built.
Mr. Secretary, appreciate your time, sir, as always, to break down the situation. Hopefully we can engage on this conversation again. Chris Wright there, the Energy Secretary of the United States. The big push we're expecting on the regulatory side to make this a whole lot less costlier.
Yeah, and how much do you actually get that to result in some of the plants that he's talking about? That is going to be a real question, and we have already seen some of the hyperscalers make direct investments, as he was talking about with forward contracts, to absorb some of the costs. I do want to see it come to fruition in terms of really understanding what the scope will be.
To Jonathan's point, state by state, it's even more nuanced than that. You have to go local board, by then county board, by then state board to try to get things like a transmission line to go across the United States, and that is why it has been so difficult in the United States.
We talked about the mine. You've got some of the copper deposits here in the United States. Trying to get those mines built takes a long time. Coming up on this program, fresh inflation data. We'll speak to Alejandra Grindel of Ned Davis Research. She's here to react in just a moment. From New York, this is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
"60 minutes away from the opening bout, just a few moments away from some breaking economic data here stateside. Into that equity futures, positive by a third of 1% on the S&P and up by 0.4% on the Nasdaq 100. Into the bond market we go on a 2-year, 10-year and 30-year. Bond yield shaping up as follows. Yields higher by 2 or 3 basis points to the very front end of the curve. The 2-year 374.80. On 10s at the moment, up 3 basis points at 426.90. With that economic data for you, let's cross over to Mike McKee, who has more. Good morning, Mike.
Good morning, John. Well, personal spending comes in negative, down 0.1%, and that's been a concern for the Fed. Is the economy slowing because consumers are slowing? We saw in yesterday's GDP report that consumer spending had fallen much more than the government had originally reported. Now, on the inflation side, we're pretty much exactly what economists had forecast. They're pretty good at the PCE, 0.1% on the headline number, and 0.2%, a little bit higher inflation on the core. That puts the year-over-year numbers at 2.3% for the headline, up from 2.1%, 2.7% from for the core on a year-over-year basis, up from 2.5%. So if you did want to make the case for a July cut, it gets a little bit harder now because the Fed is further away from its 2% target. And the other number we've got here, personal income, is also a drop, down 0.4%. It rose 0.8% last month, so a lot of give back there. The consumer is cutting back on spending, it appears, and their income, their ability to keep spending, falls in the month of May. So not a particularly good report for the economy overall. The spending and income numbers make a case for the Fed maybe starting to think about cutting. The inflation numbers pushing the other direction.
Mike, we mentioned to you earlier on this morning the difference between the July meeting and the September meeting for the Federal Reserve. You might just sit there and flippantly say just a few months, but you made the point that actually they will have a potentially very different economic picture given they get so much more economic data.
Yeah, we get CPI 3 times before the next Fed meeting. We get 2 more PCE reports. So the Fed will have a much better idea of whether tariffs are feeding into inflation. We get the July CPI on the 5th, or the June CPI on the 15th of July. And that may not capture it all either, but what people will be looking for is specific sectors that might be seeing some inflation pressures from tariffs. And then once we see the reciprocal tariffs and what's going to happen, then you can look at the July and August numbers before you get to the September 17th meeting.
Mike, thanks for the update. Mike McKee there, just breaking down the economic data. Off the back of that data, not a big move in this market right now. At the front end of the curve, yield still higher by 1 or 2 basis points. Similar move at the long end of the curve on a 10-year at the moment, 425.92. If you just wanted to frame the economic data, though, at the moment, you've got this spread between the hard and soft data. Question we've been asking Lisa repeatedly over the last several months. Soft data's down here, depressed, hard data is still robust, resilient. If that spread compresses, if we reconcile things, how do we reconcile things?
And what people are kind of coalescing around is a little bit of both. You could see the top line data come in just a touch, and you are seeing that with downside disappointments from economic data. And you see some of the sentiment improving, which you also see, especially as some of these tail risks are removed. This is a very confusing group of data because you can make the argument they're just the hints, the whiffs of stagflation, but you really can't make any assumptions because it's within the range of where things have been bouncing around.
You do the same thing with the labour market data, a hint of stagnation.
Yeah.
You look at jobless claims, still okay, continuing claims, not very good.
So what do you do with that? What do you do with stagnation, given the fact that people have been saying we're on this tipping point, but it hasn't tipped? And that's the reason why I guess that there are Fed officials that want to wait for more.
Wait a few months and maybe wait until September. Joining us now to have that conversation, Alejandro Grandal of Ned Davis Research. Alejandro, welcome back to the program. Just frame things from your standpoint. Where's this labour market at right now? Chairman Powell spent hours talking about an economy that was solid. Do you believe it's solid?
You know, of course, solid is a relative call. And again, thank you for having me back again. So the way I would frame the labor market, it's not a super technical term, but I would say it's okay. So we've been seeing signs of softening through a broad array of reports, whether it's the jobless claims, some of the continuing claims data we saw yesterday rose to the highest since 2021, some weakness in payrolls, more balancing in the labor market from the JOLT survey. But if you look at most of that data, it's still quite far from their recessionary thresholds. So it still gives the Fed some time to sort of sit and wait and see how a lot of these potential policy changes can impact growth and inflation in the coming months.
Alejandro, can we continue to see this sort of just weakening but not weak trend? When does weakening tip over into weak?
Our base case scenario is kind of, you know, just sort of going about a slower pace of growth, not necessarily recession, which is, I think, of what you meant by weak. Ultimately, the main thing to watch is the labor market. So we've kind of had these slowdowns in growth over the past few years, some upticks, but we haven't fallen into that recession territory really because of that resiliency in the labor market. So that's why we're watching it so closely. I don't know. Our base case is that we kind of muddle through with about the same, sort of this slowing in growth, but still away from recessionary thresholds. But again, it's very dependent on policy. If most of the downside risks come into fruition, whether it comes through tariffs or higher inflation and increased uncertainty, we could see pronounced weakness in the labor market. If the tariffs sort of settle at a more reasonable level, we get the big, beautiful bill with tax cuts and some expansionary policy, then that could sort of keep the labor market from falling over the edge. So just in general, a lot of uncertainty, pretty much what you guys were mentioning earlier.
Which is what everyone's been talking about. We have a week until that July 4th self-imposed deadline for the one big, beautiful bill where no one's going to be going on vacation, ostensibly, because John canceled it or Anne-Marie canceled it earlier. But there is this question going forward about how much the economic outlook could change, not only with a week from now, that July 4th deadline, but also July 9th. How big is the sort of range of scenarios for you?
Well, again, the base case and the highest probability of more than 50% is just slowing growth and then either stable or slightly higher inflation. So kind of what you guys mentioned before, that stagflation light. But there are some tail risks that you could maybe see things get extraordinarily better, right? Let's just say we do miraculously get these 90 deals in 90 days within the next couple of weeks, or less than that, actually, within 1 week. We get the big, beautiful bill. That could be, maybe a tail positive upside surprise, but I think it's a lesser likely scenario. And then I talked before about the potential recessionary scenario, but I do think that's lower as well. So yeah, base case, actually very in line with what the Fed has said, is a slowdown in growth below potential, but still positive, and slightly higher inflation.
Well, you have individuals who are saying, like Michael Hartnett this morning, a pivot from tariff to tax cuts, rate cuts could lead to high risk of a bubble in the second half of the year. But you think the second half of the year is still going to be talking about policy uncertainty in Washington, D.C.?
Yeah, I do think part of it is I don't think these tariff deals are going to be done that quickly. So there's still going to be some back and forth and some uncertainty. We should have a little more uncertainty from the big, beautiful bill. I would suspect that's probably going to get approved at least over the next month or so, or we get some closure there. But I do think the tariff uncertainty will continue. And the impact it's going to have on inflation will take some time. So I think we'll be watching the data. And then there's also a lot of other policies that have happened since the beginning of the year. We had the DOGE cuts at the beginning of the year that could have reciprocal impacts on state and local governments, what we started seeing at the federal level, and then also the immigration policies. What are they going to do to the labor force? What are they going to do to growth? So it's not just those tariffs and big, beautiful bill, but there's a lot of other things going on that may just have more of a delayed ripple effect as the year progresses, and just contributing to uncertainty.
How quickly do we need to get to some clarity on all these issues for the U.S. to maintain this exceptionalism?
Well, exceptionalism, the way I describe it, is just the fact, especially compared to the rest of the developed world, we just have the potential to grow so much faster. And it's pretty much just based on two things. We have generally faster labor force growth. We have faster productivity growth. And over short periods of time, it's really hard to see the effect, say the long-term effect on the long-term growth of those items. But if we were to see a huge reduction in our labor force because of maybe some of the immigration policy, some of the early retirement we've been seeing, that could create a downside risk to long-term U.S. exceptionalism and growth. And then, of course, tariffs, right? Holding all else constant, tariffs reduce competitiveness. They reduce the gains from comparative advantage and could reduce that strong productivity the U.S. has. On the other hand, we're also just generally more productive than a lot of the developed world because we're less regulated. We have more fluid labor markets. We have lower taxes. Big, beautiful bill will probably contribute to that as well. We're also energy independent. So there's a lot of things that still work in our favor, but there's a few policy items that could whittle down some of that advantage that we've had for several years now.
Every time I see you, I want to move to the suburbs. Every single time. I want that grill. I want that terrace.
The trees in the back. I think she should run Architectural Digest.
We're moving to Florida.
Yeah.
Oh, gosh, stop.
Seriously, it's always
this
beautiful.
happen.
It's like perfect.
We're moving to Florida.
We're moving
Alejandro Grandal of Ned Davis Research will be our first on-set guest.
Totally.
Pick a city.
You actually
Where'd you wanna
invented
be?
this. Governor Hochul said this, that I can't think about raising taxes because I can't lose any more people to Palm Beach. That's what she said this week.
We don't want Governor Hochul to come with us. We're moving to Florida.
All I can say is, you really want the weather that we got earlier this week? That's all I can say.
I don't mind the weather.
Are you kidding?
I carry the weather.
Earlier this week?
Good aircon down there, haven't they?
Okay, yes, but you want to go outside.
Get up
That's
early.
Suffocating. Nobody.
We get up early, don't we?
I mean, so then you just avoid, you don't go outside. You just hide in a closet.
Get
That's
up early. Who says we're hiding in a closet?
Go to the beach.
I don't think you think that's what they do in Florida?
We're going
just
paddleboarding.
Hiding in closets.
We're getting a boat.
My goodness, Bramo. What are you doing this morning? Mike McKee's back with us now to break down this economic data. Mike, you've had a second look. What do you see?
Well, there's some interesting detail underneath everything, John. In the personal income category, wages are hanging in there. They were up 0.4%, so no real problem for Americans who are spending what they earn. We had a big drop in farm payments, about 50% over the month, and a drop in Social Security payments, 7.3%. So it looks like this isn't as bad a number as it would appear on the surface. Spending numbers were kind of interesting. We had a big decline in goods spending, particularly on durable goods, down 1.8%, while services spending rose an anemic 0.14%. So you can see that Americans backed off in both areas. So the final number I would throw at you is the savings rate falls to 4.5% from 4.9%. So even if wages are hanging in there, it looks like people spent down a little bit of their savings to even do the meager spending that they did.
Mike McKee, appreciate the update. Thank you, Mike. Have a good weekend. Mike McKee there breaking down the economic data for you. Lisa, it feels like we're going into July without this debate changing much over the last 2 months. Economists haven't really changed their course on much at all. Market participants have. Market participants have because things have de-escalated in such a material way across so many different things.
How do you price in tail risks that could potentially totally upend the modern order of trade and the modern order of the U.S. economy, where people are questioning U.S. exceptionalism? People really struggled with it. And now we're back to a place of just actually looking at the economic data and the sort of muddle-through economy that we've been dealing with. The real sort of overlay here is the fact that profit margins for the big tech companies have come in so big that they have eradicated a lot of fears, and frankly, the narrow breadth in the market has been a boon, because if you can keep betting on that, that will keep driving you forward, and that is the belief right now, at least in markets.
The S&P is at an all-time high. Only 22 participants are also at all-time highs, according to Michael Harnett, according to him, over at Bank of America. But they're the right 22, which is why we're at a record, because they have such a heavy weighting on the S&P.
The stock market is not the economy, and maybe that's a good thing.
You've said that repeatedly.
And that's what people are looking at.
And you're absolutely right. We'll get another read on the economy later on at 10 a.m. Eastern Time, when we get a read on consumer confidence, consumer sentiment with the UMich survey. Is it an economic survey or just a political poll? We'll have that debate again at 10 a.m. Eastern Time if you want to tune in for that. And then next week, it's Payrolls Thursday, not Payrolls Friday. Just want to throw that out there once more. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with a recap on all that economic data. The Fed's preferred measure of inflation rose in May. Core PCE increased 0.2% from April, slightly higher than estimates calling for 0.1%. At the same time, consumer spending declined by the most since the start of the year, indicating uncertainty around the Trump administration's economic policies are weighing on growth. Meanwhile, Andrew Cuomo is not quitting the New York City mayor's race. Sources telling us here at Bloomberg he'll appear on the ballot in November as an independent, despite pressure from donors and advisors to drop out. It comes after Cuomo's stunning defeat in the first round of the Democratic primary by the Democratic socialist Zohran Mamdani. And Anna Wintour is stepping down from her role as editor-in-chief of American Vogue after 37 years. The magazine is seeking a new head of American editorial content, a newly created position that will be responsible for daily editing duties. Wintour will continue to work for Condé Nast, overseeing all of its global brands and likely still going to all those sporting events. That's your Bloomberg Brief. John?
Yahira, thank you. Have a wonderful weekend. Bramo's got thoughts.
No, I just
It's a vacancy you could fill. I could see that.
Are you kidding? I am the least person. I'm not a stale in my opinion. I don't think anyone would confuse that.
Change everything.
Yeah.
Change style.
Let's just wear paper bags. No, I'm kidding. I'm just saying. I don't
hide in closets, apparently, if you live in Florida.
Closets. I don't think anyone wants to see me in the charge of fashion.
Do you want to explain that?
No, I don't, actually.
Got a very faithful audience down in Florida.
The truth is, it gets very hot.
Okay.
And so, do you go outside and be on a boat? If you do happen to burn very easily, do you just hide in a closet?
Oh, right, okay.
50%.
The sunscreen issue.
Yeah, we really don't need to be having this conversation.
We can do this later. All right. Up next, let's set you up for the day ahead. We'll catch up with Gennady Goldberg of TD Securities. Plus, Danny Berger with your morning movers as Nike jumps following earnings. That stock is up by 11% in the pre-market.